might have heard about this. So why some people might be hearing for the first time. So especially people just writing CR for the first time. So there are some orientation I had when I started ICANN, although I didn't hear it very early, but I started when I had it and it's working, and when I tell people it works for people. So one of it is when you are writing on your exam day, um, it is very advisable to attempt all the 5 questions in the exam hall. Just make sure you attempt all the 5 questions the examiner told you. And there is this thing I was told during that orientation, but day before yesterday, okay, was it on Friday or Thursday? I'm currently preparing for my exam in June, ACCA. So I had a webinar. So the examiner also stated they did a webinar like a orientation for student preparing for exam. So then the host presenting that webinar now made mention of it. And I said, wow, I need to tell people this because so many people don't know. So what am I saying in essence is that you need to allocate your time in the exam hall. The exam hall, you have 3 hours, 15 minutes. I said 15 minutes is reading time, right? So you have 3 hours, approximately 180 minutes. So now, if you want to write your exam, this is a professional advice that I have been using during my skill and I'm using my finals, and it made me pass a lot of papers at a sitting. So this is how this is how it works. Can people see my Excel screen? If you can see my Excel screen, can you just react? Okay. Now let me move to the Excel screen. To the Excel screen now. This is it. The total time you have in ICANN exam hall is 180. Is 180 minutes. You have 180 minutes in the exam hall. That means 3 hours. An hour is 60 minutes. Then the total marks you are earning, you are fighting for in the exam hall is 100 marks. So what they are saying professionally is that you allocate your time, allocation of time in the exam hall. When you want to allocate your time in the exam hall, what they are saying is that you should divide 180 minutes divided by 100. Then you get 1.8 minutes. So a mark, when you are fighting for 1 mark in the exam hall, you should spend 1.8 minutes. So invariably, your question number 1, which is your group account, 1.8 minutes multiplied by 30. Let me quickly use my calculator. I think I have it here. You have 54 minutes. So whenever you are solving your group account, your question 2 and question 3, please spend 36 minutes. Please spend 36 minutes. That means when you are calculating your ratio and the like, spend 36 minutes. Why your question 4 and question 5, please spend, how many marks is that? Is it not 15 marks? So multiply your 1.8 multiplied by 15 marks, 27 minutes. 27 minutes. 27 minutes. So invariably, if you add all these together, you have your 180 minutes. 180 minutes. So this is what they are saying in immediately you are in the exam hall. Please, when you are solving question number 6, question number 7, or question number 5, please use 27 minutes. Immediately you are done, look at the time. There is time in all the exam hall that have been. Maybe it is 27 minutes. Please stop that question. Even though you know it, please stop. Move to another question. Solve question number 2. Spend 30 minutes. Question number 3. Spend this allocated time. In 3 hours, you attempt all the 5 questions. So any question that you now know that I know this question very well, you can use 30 minutes here. You can use 30 minutes here and use now add that 6 minutes to this 27. Then you can now use 33 minutes here because you know it very well. So what am I saying in essence? Let me go back to my screen now. Does everybody understand what I just said now? Can we react? Can we react if you get what I said? So this is exactly how I did my skill level. I wrote 5 papers. I passed 4. In my final 2, I wrote 5 papers. And this is a professional advice. This is a professional exam where you need to allocate the moment. In fact, the papers I failed, which is PM, and in final I failed at advanced audit. I know I fumbled because I don't have much time to read and the likes. And that question was tough. I already know that I'm going to have issue with this paper in the exam. So many people will just go to the exam. In fact, some people will spend 2 hours in question number 1. You now allocate like 30 minutes or 15 minutes. Some people will answer 3 questions. Some people will answer 4. And you say you want to pass. Please, if you are just hearing this for the first time, please take note of it. In fact, that's what the SCCA somebody told us day before yesterday. And now remember that people have advised me about this in ICANN, and I understand that you need to manage your time and allocate your time effectively in the exam. So in the moment you allocate your time, you attempt 5 questions, even though you make mistake and you perform woefully in a 15 marks question, maybe in 15 marks question, you score only 5. The moment you answer the remaining 4 very well, you will pass. I can't say you should score 50 marks. You will pass. So for the moment you are now answering 3 questions or 2 questions in the exam, you know that problem don't deal. So that is what I wanted to explain since all this while. I now remember the voice. I said I'm going to tell people this is how to write a professional exam. Allocate your time and make sure you read very well. Because if you read very well, that's when you can answer 5 questions. If you do not read very well, there will be begin. So the remaining time we have, please let's read. If you are still watching movie by this time, you are wrong. Just like my lecturers, you are wrong. So now 4:30. Now I think we can start our exam. Sorry, I think we can start our class now. This is exactly 4:30. So exam. As if me too, I'm preparing for exam. So everybody's preparing. So now let's start our question. So let's move to our question now. This is question number 1, a composite question, May 2024. Kabbalah Nigerian PLC. And if you remember very well, I said it that except case study, the rest, if you are starting your question, please, the best advice I will give you is to do what? Is to start from requirements. Please start from requirements. So let's go to our requirements. I said, as the financial controller of Kabbalah Nigerian Limited, draft a report. Can we see now? So immediately we look at the requirements. Draft a report. Wow, a report, 18 marks. Okay, you have known that okay is a report because when you see question number one, everybody's mind is group is consolidation. We are merging asset and we are doing this. No, and that's the reason why I usually tell people that this is what I learned from my lecturers. Our lecturers that have been lecturing for the past 15 to 20 years, they tell me that go to your requirements. The requirements will tell you that okay, this is what they are saying. You have the report addressed to your finance director of your company explaining adjustments. Can you see? Explaining adjustments, any adjustment which need to be made to ensure subsidiary company Masakoko financial statements comply with IFRS requirements. Wow. So when I look at that requirement, I say, okay, explain adjustment. Okay, it's like that subsidiary financial statement is not complying with IFRS. Okay, now I go to my P, prepare a revised statement of financial position that will be suitable for consolidation. That will be suitable for consolidation with the parent company financial statements as at 30 September 2023 in line with IFRS. So look at it now. So looking at the example, looking at the two requirements, I'm not even um I'm not even required to prepare uh my consolidated statement of financial position. So, but if you don't start with the requirement, there will be a big in the exam of that they said we should prepare consolidated because you know the requirement. So now we have read the requirement now. So let's move to the beginning of the question so that we can start solving. Okay. Now we can start now. Kabbalah Nigerian PLC. Okay, let me quickly go back to my screen. Please, okay, we don't have a question yet. So please, if you have any question, I have muted everybody. So have I muted everybody? Yes. So if you have a question, please we can raise up our hand. I'll be coming back to be checking if you have any question. So now let's start with the question now. So Kabbalah Nigerian PLC is a company located in Ajao Industrial Estate, Lagos. The company specializes in the production of Adire t-shirts. The company has a number of subsidiaries located in South and Southwest region of the country and overseas. On 1st October 2022, Kabbalah PLC acquired 100% shares of Masakoko Nigerian Limited. So on the 1st April 2022, the parent company acquired this Masakoko Adire t-shirt distribution company based in Gambia, West Africa. The official national currency of Gambia is known as Gambia Tilasi. So immediately you see something like this. You see two companies. One is in Nigeria, the other is another country, or one is in US, the other is another country. You should know that the question is a foreign subsidiary question. So they told us the draft statement of financial position of Masakoko Limited prepare under the Gambia GAAP. What is GAAP? Generally acceptable accounting principle. As at September 30th, 2023, is as follows. So they give us the non-current, which are PPE, intangible asset, financial assets. Now, they give us equity and liability. They give us share capital at GMD 1 per share. That's the nominal value. Then retain earnings, evaluation surplus, loan notes, and the likes. So additional information. The following are the key transactions of Masakoko Limited under the Gambia GAP. There is no deferred tax under Gambia GAP. Hope we note that. Please let's note that. They said there is no deferred tax. You know, in Nigeria, under IFRS, there is deferred tax. But here, they say there is no deferred tax. And for you to comply with IFRS, there is deferred tax at years 12. Okay, let's go. So, number one, additional information one, equipment. They said January 1st, 2023, Masakoko acquired some specialist equipment from United States for 150 million. Payment was made on 31st March 2023. The specialist equipment was purchased on 1st January 2023. Sorry, I want to unmute everybody. This additional information, I want everybody to flow together because there is something I'm seeing there. Immediately I saw this question, I said, even if I was the one in the exam or in this question, if I did not read the additional information very well, there will be issue. So I want to let me allow microphone of everybody. Please, let's be muted. Please, let's be muted. But I want to be interactive because there are some things I will be asking. So I want us to interact. So I'll be asking some questions. So now that's the reason why. Who is Mrs. Florence Adepoju? Your hand is up. We have not even started reading question. Do you have a little clarification of question? Can you quickly ask your question if it's relating to that last thing I said? Because we have not started solving.
Okay, sir, no problem. You can proceed, sir. No
I
problem.
can continue. Okay. If you
I just want to ask that what is deferred tax?
Okay, deferred tax.
Make explanation on that.
Okay, no problem. Deferred tax is at years 12. So okay, no problem. We will discuss, we just brush through it. There is no problem. So now let's go back to our question. So now on first equipment additional information one, on 1st January 2023, Masakoko acquired some specialist equipment from United States of America for 150 million. Payment was made on 31st of March. Now they said, in accordance with local Gambia GAP, the cost of equipment was recognized on 1st January 2023 at 50 million using the opening rate of exchange at October 2022. That's number two. Additional information number 1/2. Let's use that way. Now, full depreciation of GMT 5 million was charged to cost of sales as Masakoko depreciates the equipment over 10-year life and it has no residual value. Hence, the equipment was included in the statement of financial position of Masakoko Limited at GMB 45 million. Now, the sum of 12.5 has been debited to retained earnings. This is in respect of difference between the amount paid to the supplier of GMD 62.5 on 31st March and the cost recorded in the non-current asset of 50 million. So now, the first question I want to ask, when we read the requirements, what is requirement one? Requirement one is saying 18 marks question. And what I actually see in this question is that when you read the requirements, just like I explained when we started this tutorial, that in professional exam, when you want to start solving any question, please go to your requirement first. Please, if you don't know, please know it now. Because if you don't know, if you not go to your requirement first, in fact, there will be an issue. Please, let's know that one first and foremost. Now, number two is that when you are now reading your question, please, as you are reading a particular paragraph, let's say you are reading 2 paragraphs, you need to be going back to your requirements so that because there are some points in the question that you will be picking. I don't know what's happening to my screen today. I supposed to highlight. Do you remember that I usually highlight my screen so that I will send you?
Yes,
Please
sir.
do that. Yes. In your exam, please buy a pencil. There are some questions that you see 5 pages that you'll be wondering that where can I start from? In ICANN, look at this question, and this question is 4 pages, 3.5. You are not going to be scared that where will I start from? Whereas you can solve that question. Oh shit. Please let's be muted. So where am I going now? The requirement 118 marks is saying we should explain any adjustments which need to be made to ensure the subsidiary financial statement comply with IFRS requirements. So they asked us to explain some adjustment. So what this requirement number 1 is saying is that if you understand IFRS very well, if you have read IFRS, if you know IFRS very well, you will score like 13 marks, at least 13 marks in this question. 13 marks if you read IFRS very well. But if you are somebody that don't like IFRS, hey, this question will be a problem. So that is number 1 thing I cited in this question. But if you understand IFRS, in fact, you can score 16 over 18. Because that question number requirement A is pure IFRS. Pure IFRS. So now let's go back now. They asked us to prepare a report explaining adjustment because that Masakoko, that company, that subsidiary company, they are using Gambian GAAP. So they are not using IFRS. However, the parent company financial statement comply with IFRS. So you need to make sure the parent and the subsidiary company's financial statements are in line. Both of them must comply with IFRS. So now my question number 1, that's the reason why I unmuted everybody, because I want to ask some questions. So number 1 is that looking at this equipment, how many standards did we think they are testing in this question? Which key standard are they testing in this additional information 1? That's my first question. That if we read it together now, which key standard are they testing? Although it's not only 1, I can see 2, but I want to ask. Okay.
1 is IS-36.
IS-36?
IS-38. And
no, wait. Let's get it very well. You know, we are in additional information 1. Anti-Latifat, please get with this additional information 1 talking about equipment. That's the only one I'm saying though. This equipment, which standard are they talking about?
IS-16.
IS-16, okay. Thank you. You can unmute. You can mute yourself. Adiola, is this Adiola? Okay, Adibola. You want
Adibola.
To say Adibola, okay.
Yeah, I'm actually not saying something to the question you asked. So I wanted to suggest something. So I think you can actually highlight the let's say the keywords that you want to highlight if you open it with WPS or something else, because you open it with Chrome, that's the reason why you can highlight it. I think highlighting it will be better so that anytime we want to look at it, we would get it fast and we don't have to be here. Thank
Yes,
you.
yes. And remember that was what I did last week Saturday, and it was fine. And that's why I usually do, but I don't want to waste more time. Okay, okay, that's fine. That thank you. So okay, I think Auntie Adibola, Abimbola, I think you want to answer my question. Are you not answering my question?
Yeah, IS 16. That's what I was about to say.
Only IS 16? Only IS 16? Okay, who is answering me and who is attempting again? Let me open my
IS 21.
IS 21. Okay, thank you, Mr. Sadiq. We again, Mrs. Charity, I can see your hand up. Do you want to answer my question?
Yes, sir. IS 16 and 38.
38. This this equipment that I just read to, I'm not this additional, we are picking it one after the other. So IS 16 and 38, right? Okay, that's fine. Thank you very much. So um, okay, that's fine, that's fine. So that our time is going through, we need to be fast. Let's continue now. So what I want to emphasize on is that this question is talking about which year is this. Sorry, I'm using the WPS now so that we are going to be highlighting the key words, just like my Abimbola advice. So okay, November 2023. So the next diet after that. I think the next diet after. So okay. So let me quickly say the answer. So this additional information one equipment, the key and the first thing that additional information is testing is IS 21. That's the first. Immediately, if you know IS 21 very well, if you have read it very well and you saw that something, you know that it is testing I 100% IS 21. I cannot say 100% 21. I can say 70% because 30% is IS 16. Because or let's say 60-40. 60% IS 21, 40% IS 16. Because the equipment ports, if you want to account for that equipment, you account it in line with IS 16. So, and the equipment was just bought. So immediately it was just bought. So you account it with IS 16. So who answered my question again? Somebody again said IS 38. Please, there's no IS 38 here. Oh. Please, oh, let's be careful. Let's stay together. Oh. Let's stay together. Oh. IS 38 deals with intangible assets. And there is no intangible assets here. Oh. Please, there is no intangible assets here. So I'm in the question now. So there is no intangible assets here at all. So this additional information one does not involve IS 21 at all, IS 38, sorry, IS 38 at all. Please, let's take note of that. So that's number one. Now, having been said that, we have concluded that it is IS 21 and IS 16. So now we are now going to look at the question. Look, let's take it one after the other now. The question will be very, very interactive. Then when we start solving solutions, then I can now mute everybody. Then we now start. So now let's take it again. On 1st January 2023, Masakoko Limited acquires some specialist equipment from United States for $150 million. That's the foreign currency. The functional currency, in line with IS 21, IS 21 defines what is functional currency. That means the currency in which an organization is reporting its financial statements. Like this for this company now, Masakoko, the company is in Gambia. So the functional currency of Masakoko Limited is Gambian Dalasi, GMD. So that is the functional currency. And that is why IS 21, that's why it defines functional currency for. That's point number one. Point number two is that the subsidiary company, Damasakuku, he now bought a specialist equipment in USD. So that is a foreign transaction.
Not hearing again.
You can't hear me. I can. Please hear me. Oh. Hey, can you hear me now?
Yes, sir. Yes, sir.
Okay. Let's continue now. So now, let's go. Now we have established the functional currency, right? Yes. Functional currency is Gambian Delasi. Now the foreign transaction is US dollars. That is a foreign currency. Now, IS 21 now says something that the first thing IS 21 defines is what is functional currency, what is foreign currency, what determines the functional currency of an entity. In fact, any question they set IS 21, they will ask you that question. And I have forwarded IS 21 to your group. Please go and read it. I will forward it again in the night. Because of this question we solved, I'll forward all the standard we tested today. I'll forward it tonight. I'll forward it to everybody. So I will go and read it again. So now let's go. Now, what IS 21 says is that when you buy an asset in foreign currency and you want to record it, and you want to record that asset in your financial statement, IS 21 says, please wait to use the cost, use the foreign currency as at the date of transaction. Let me say it again. IS 21 says when you buy an asset, and sorry, let me quickly say this again. And that was what I wanted to do before, but I feel we are going to use 5 hours here. And that's the reason why I'm going to forward the standard. I will be taking the standard one after the other, the requirement of the standard, and we will be applying it. Because if we say we should talk about IS 21, we will use 10 o'clock here. We discuss about IS 21, we discuss about impairment, we discuss about this, we discuss about that. So I'll just be telling you the requirement. Then when you are solving this question on your own, go to the standard, read it, then you understand better. So now, IS 21 says when you want to record a foreign transaction in your financial statement, you should take into consideration of 2 things. One, you should determine whether that asset that you want to record in your financial statement, is it monetary assets or non-monetary assets? We call it monetary items. It can be asset or liability. So IS 21 defines what is monetary assets and what is non-monetary assets, what is monetary liability and what is non-monetary liability. And that is when you remember your definition of intangible assets in line with IS 38. IS 38 says what? Intangible assets are what? Are identifiable non-monetary assets. Identifiable non-monetary assets without physical substance. That's the definition of IS 38. What is intangible asset? If you want to define it for anybody all over the world, that's the definition of that person. So that non-monetary assets that IS 38 is saying, it is IS 21 that defines it. Because when you look at it, you say, what is non-monetary asset? So it is IS 21, and that's why I usually say it, that all standards are related. For you to understand standard, you need to read all the standard. So now let's go. There is no time. Now, the first thing I'm establishing is that when you want to record your assets in your financial statement, and it is foreign transaction, IS 21 says you should measure it at the exchange rate as at the date of that transaction. Now, let's go back to the question. There's something I want to show everybody. Please, let's be muted to this question. Let's be muted to. Now, look at this exchange rate. Exchange rate as at the date, as at this date. Let me highlight it like that. Okay. On 1st October 2022, exchange rate is how much? Is $3 per 1 GMT. Now, on January 1st, 2023, exchange rate is what? Is $2.5. Then on March 31st, exchange rate is this. Abi. Now, on September 30th, exchange rate is this. You see that there are 4 different exchange rates, and it is normal because the rate of dollar tomorrow, we are all in Nigeria. The rate of dollar today is not rate of dollar tomorrow, and that's what is happening here. In real life, the exchange rate changes every day. So now let's go back to the question. Now, there's something I want to establish. Everybody is unmuted. I'll ask a question now. Now, in accordance with local GAAP, the cost of the equipment was recognized on January 1st, 2023 at $50 million using the opening exchange rate at October 2022. This is where we are going. The asset was purchased on 1st January 2023. But when Masakoko wants to record it, he now record it on this. He record it on when? On using the opening rate. Please let me highlight it. Permit me to highlight it. Using the opening rate. And that is my question number 1. This company bought an asset on 1st January 2022. They now record it as the exchange rate as at October 1, 2022. Are they right or wrong? Is that the requirement of IAS 21? That's my question.
They are wrong.
They are wrong.
They are wrong.
Yeah, wrong.
They are wrong.
Okay.
They are
So,
wrong.
okay. So people did not get what I just asked you. What I'm asking is very, very key. Please, if you don't understand, please, if you don't understand, please react so that I will know, so that I can come back again.
Take it again.
I said, okay, no problem. I've gotten what I want to argue, I will get. No problem. Now, the this transaction, when Masakoko wants to recognize that transaction, when they want to recognize it, they use what? They use exchange rates as at this date, opening rate. Can you see it? At opening rate of October 1st, 2022. Whereas the standard IAS 21, IAS 21 says, whenever you want to record transaction of a foreign currency, and that asset is a non-monetary asset, please, IAS 21 says you should use the exchange rate as at the date of purchase. So what I'm saying in a nutshell is that these assets, when Masakoko wants to recognize it, they're supposed to use the exchange rate as at 1st January 2023 and not 1st October 2023. Invariably, what they are saying is that this is wrong. What Masakoko did here is not in line with IFRS, it's not in line with IAS 21. And now, what is the requirement of examiner? Examiner said you should make necessary adjustments. That you should explain and make necessary adjustments. That anything that is wrong, you should correct Masakoko. Because we want to make sure the financial statement of the company is in line with IFRS. So this first paragraph and second paragraph, what we are establishing now is that what they did was wrong in line with IAS 21. What they're supposed to do is that they should have recorded it on the 1st January 2023 and not not date of opening rate, which is October 1st, 2022. So that is what we are establishing. So if you get that, can you now react? Can we react now? If you get that now, so that we can move on. Okay, okay, okay. I can see ants. Yes, yes. So we can move on now. So now, let's move on. Let's move on. So that's number one. We have spotted an error and we need to correct that error. We need to make necessary adjustments. Now, what I will now do is that I'll be taking it one after the other. We will take equipment. After we take equipment, we go to the solution, we address it. Then we move to impairment. Then we address it again. Then we do this again, we address it again. So let's go now. Now, full year depreciation of GMD 5 million was charged to cost of sales as Masakoko depreciates equipment over 10 years and it has no residual value. Hence, the equipment was included in the statement of financial position of Masakoko Limited at GMT 45 million. Now, this full year depreciation of 5 million, we are now going to ask ourselves, is it right or wrong? That's a question we ask ourselves. They charge a full year depreciation. That means a 12-month depreciation. Now, we now need, this is where IAS 16 is coming in. So the people that said IAS 26, IAS 16, they are right. Now, depreciation, now which standard talks about depreciation is IAS 36, extensively on depreciation. IAS 36. So what is IAS 36 saying? IAS 36 says that when you buy an asset and you want to calculate that asset, it is from the date of usage, the day you buy it, the day you start using it, that is when you start your depreciation. Now, when did they buy that asset? They buy it on 1st January 2023, right? Yes. Now, what is the accounting year end of that business? Let's check. Let's check. September 30th, 2023. So the accounting year end of business is September 30th, 2023, and they buy the asset on 1st January 2023. So our depreciation in line with IAS 16 is that we are going to prorate it. Thank you. It will start from on the 1st of that January. So let's count our hand with our hand now. January, February, March, April, May, June, July, August, September. 9 months. 9 months. That is the correct, the actual depreciation that we're supposed to charge to cost of sales. So invariably, this 5 million is wrong. This 5 million is wrong. Let me highlight it as red so that we remember that it is wrong. So they charge a full year. How many months are there in a year? 12 months. So they charge 12 months into cost of sales. Whereas they're supposed to charge 9 months. So our second correction is that we are going to adjust that depreciation that is wrong. Then we will now recognize what is right. So does everybody understand this again? Okay, okay. That's good.
No.
Atide. Okay. Who is saying no now? Who is that? You can unmute. Okay, okay. What's the problem? What's the problem?
I didn't get what you said. Like, I was trying to understand this part that you explained, but I didn't get it.
The depreciation, Abby?
Yes. Depreciation and those things.
Good evening, everyone. Please, I'm sorry I'm lost in this class. Is this class not supposed to start by 5 o'clock? Where am I? Is this not CR class?
This CR class now is
I want
because...
to start by 5.
No, wait. The class is not starting by 5. And that's the reason why, okay, let's say I'm sorry about that. Okay, we are sorry about that. That's an error.
Because this class is supposed to start by 5 o'clock. That is what I'm expecting. I'm just surprised. I'm not
Don't worry, don't worry. We are sorry about that. We are going to adjust the timetable. But don't worry, you are not missing anything. The class is
I'm just
recorded.
joining now. I don't even know where you are.
Okay, we are just starting the question. The question has we are not that far yet. We are not that far. Don't worry, we are not that far.
I'm
Sorry,
not happy about this.
we are sorry about that. So
What
that
is
was
what year's question is this, please? Sorry.
that's May. We are not checking our group. That's another issue. I sent this question to your group. May 2020. This is there. May 2024 question 1. And that's the reason why I usually send it there. I usually send this information so that we will see it. Question number 1, May 2024. I've sent it to this group. So that's it.
Is it the question you sent that changed the time or something?
No, it's not. If you remember last week, we started 4:15. So I don't even look at the time. I thought it was 4. I never know who changed it to 5 because 2 hours 2 hours is not enough. When you look at it 5 to 7, 2 hours following subsidiary, I cannot. It is, if I have seen it, I will have changed it since. I thought it is 4. The class is 4 and we gave everybody 15 minutes time to like adjust. So 4 to 7, 3 hours is okay and we'll be fine.
It's 5 that has been on the timetable since you sent that timetable to me, sir.
No. The
No,
last
it's
week,
not 5, it's 4.
go and check it again. Last week was not 5. Go and check last week Saturday's class that I took. So please, there's nothing bad up till now. We just started the question. You get it. Don't worry. You get it. And the class is recorded. You are not missing anything. Please, let's continue. So, Auntie Mary. Okay, Auntie Mary was asking a question now. Depreciation. Depreciation, you said you are not getting the depreciation. So now, yes, we have not gone far at all. We have not gone far at all. So,
Please, what topic are we doing?
so let's go back to what Auntie Mary is talking about. Now, this depreciation, they told us, please, can we mute ourselves? Can we mute ourselves? Please, let's mute ourselves. I just want to unmute everybody so that this class will be that this question, this topic is very key something. That's the reason why it has to be interactive so that everybody will understand. So let's go now. Let's go. Additional information 2. We are in additional information 2. The company, the subsidiary company, charge a full year depreciation. And that's the reason why I highlighted it as red. Look at it. The asset was purchased on 1st of January 2023. And if you remember your PPE year 16, when you purchase an asset, what is the accounting entry? You debit your assets and you credit your payables. That's a normal accounting entries. So on 1st of January, that was when the asset was purchased. And it is assumed that in this question, it is assumed that when the asset was purchased, the company started using the asset. The company started using the asset immediately. So when you look at it, the asset was purchased on the 1st January 2023. And the accounting year end of the company, look at it, I have highlighted it again, September 30th, 2023. So from January 1st, 2023 to September 30th, 2023, that is 9 months. You can use your hand to count. That is 9 months. So the depreciation the company is supposed to calculate is 9 months. They're supposed to calculate a depreciation of 9 months. However, the company did what? They charged a full year depreciation, which is a 12-month depreciation. And that's the reason why I said it is wrong. And according to the requirement, according to our requirement, the examiner told us to explain the adjustment that need to be made. That there are some things that is wrong in this additional information that we should explain it. And that is it. So now, Auntie Mary, do you now understand it now? Hello?
Yes. Yes, sir. Thank you.
Okay. So
Yes,
that is
I've
it.
been raising up my hand. I don't know if you can hear me, sir.
Okay, okay. Is your question in line with what we are saying now? Oh yeah, go ahead. Quickly go
Yes,
ahead.
yes. Okay, sir. So I wanted to ask because I know that sometimes the combination of or general depreciation have to do with the accounting policy of the organization. Does it mean because some companies say that the first year of purchase that within the accounting policy they will depreciate the full amount to they will depreciate fully for that first year, irrespective of the time it was bought. So I don't know whether that is wrong as well.
Like, if I can get your question very well, that the accounting policy of the company is to do what?
What I'm saying is that sometimes when the education have to do with accounting policy of the organization. The organization can have an
Exactly, yes.
accounting policy that states that in the first year of purchase of an asset, that you fully
Yes,
depreciate that asset for that year, irrespective of the date it was purchased. It was purchased
that
in
they
the middle of
should.
the year.
Okay, that is okay. I've gotten your question now. That if the accounting policy says that, okay, my accounting policy is that uh I should depreciate based on full year. Okay, I've gotten that question very well. Thank you. You can. So the solution, the answer to the question is that accounting policy fine is at discretion of the organization. However, your accounting policy, any accounting policy you are making must correlate, must be in line with the standard. The standard is saying you should depreciate based on so. And if you go to your requirement of IAS 1, you must state it, especially that your financial statements comply with IAS, with IFRS. In fact, you must state it. So the accounting policy you are talking about, fine, there are so many accounting policy. So, but this recognition of fully depreciation, it cannot be it. I'm sorry to say that you cannot, because when you are saying that, that means you are not complying with IFRS. The accounting policy, the one I know you are, there are accounting policy in which it is the standard specifically says it that it is um it is at your discretion. It is the standard that grants you that, okay, this accounting policy you have to do it. So that is the accounting policy you mean. So there are some accounting policy in which the standard will tell you this is what you should do, and if you are following IFRS, that's what you and that's what we are saying here. And so that's the answer to the question. So now let's move on. Let's move on. Now, we are done with full year depreciation. Now, let's move to the third one. Now, the sum of GMD 12.5 has been debited to retained earnings. This is in respect of differences between the amount paid to supplier of GMD 62.5 on March 31st, 2023, and the cost recorded in the non-current assets of GMD 50. So now, this third additional information is telling us about what? It's telling us about exchange difference. Exchange difference. So in line with IAS 21, you know I said it that this additional information one is talking about two things, IAS 16 and IAS 21. So now IAS 21 also discuss about exchange difference. And whenever there is exchange difference, it's either we have exchange gain or exchange loss. And how does that work? How it works is that whenever you have a foreign transaction, due to the fluctuation of exchange rate, every day exchange rate is changing. All of us, we are in Nigeria, usually here, dollar have risen, no, dollar have rise again, no, dollar have come down. That is fluctuation of exchange rate. So when you have a foreign transaction, there will be an exchange rate difference, and that is 100%. So now, when you are now buying something from foreign companies, foreign transaction, when you buy that asset, you buy that asset last week. Now you now want to settle that asset. You want to settle that person this week. So the moment you want to settle that person, the exchange rate must change. So the moment it changes, there will be an exchange difference of exchange gain or exchange loss. So now what they are telling us in this third or fourth additional information is that the moment the company Masakoko paid for that, paid that supplier in US, the moment he paid that supplier, he now recorded the sum of 12.5 million in the retail earnings. Then the exchange difference is now 12.5. They now said it was debited to retained earnings. And when something is debited to retained earnings, it will reduce the retained earnings. So there is an exchange loss. This 12.5 is an exchange loss because it is an expenses that will reduce retained earnings. If it is exchange gain, it will be credited to retained earnings. So now, additional information one now, we concluded that the first one was wrong, the second one was wrong, the exchange rate, the exchange gain or loss, we need to determine that maybe it is wrong or not. But I'm very, very sure it will be wrong, since at the beginning, the company recorded the exchange rate as at 1st October 2022. So the exchange rate will be low, the exchange loss will be wrong. So now let's go back to our solution now. Let's go back to our solution. So now the examiner has sought to prepare a report. So to make this thing very, very fast, we have only 3 hours. Now I have started the report. So we'll be taking it one after the other. Don't worry, I'll send this report to you. So we take it one after the other. This is your format. The dates. You are asked to prepare a report. You are the financial controller. Yes, from financial controller to the finance director. These dates, please, if you are in the exam, or please, you can use the date of your exam. You can use the date of your exam. So you don't have any issue. So now, what is the heading? The heading of the report, explanation of adjustment needed to ensure that Masakoko financial statements comply with IFRS. So the following are the adjustments needed to the financial statement of subsidiary company. Now, we are picking it one after the other. The first one is equipment. The first one is equipment. So now let's pick it one after the other. Now, the equipment is what? Is categorized as non-monetary assets. You know, I said it in line with IAS 21, it is called non-monetary assets. Therefore, and IAS 21 says when you want to measure the exchange rate, you should use the exchange rate on the date of the transaction. So if you go back to the question, when is the transaction? When is the transaction date? On the 1st January 2023. That is the date. So let me do this. So on this date, that is what IAS 21 saying, that when you buy an asset, on that day, when you want to record it, and it's a foreign, record it on this date. This date, go, 1st January. So when we go back to our solution now, you see it. Therefore, it should be measured at the rate of January 1st, 2023. So the equipment should be originally recognized at the cost of 60 million. That means 150 million divided by $2.5, and the liability amount is recognized. So can you see it now? Now, where did they see this 150 million? Where did they see 2.5? Let's go back to the question. Now, the asset was purchased for what? For $150 million. This is it.
Sir. Hello, sir.
Hello.
Hello.
Hello. Yes. Yes, ma'am.
Hello, sir. Okay, how can we determine that we are going to divide or we are going to multiply? Because I can see that you divide here. How can we determine that we are going to divide or multiply?
Okay. No problem. I'm coming there, by the way. That's a great question. By the way, That's a great question. I'm coming there, by the way. There's no way you are going
Okay.
to. Yes, I'm coming there. And you, if you know me very well, you trust me that I will definitely come there. So now there is no there's nobody that will tell you about IAS 21 or foreign currency that will not explain this divide or multiply. Now, before I continue, let me quickly make reference to um where I am. Where I was that I'm here. Where did we get this 150 million divided by 2.5? I am sure little of us, like people just joining us, might be searching for it. Where is this 150 million? So this 150 million. This was the amount bought, the amount Masakoko used to buy that asset. The the currency of Masakoko is GMT, but he bought a foreign transaction of 150 million. So this is the cost of 150. Now, in the question again, they gave us exchange rates. And this is where I'm going now. The exchange rate in which they use, Masakoko use 3 naira, which I said it is wrong. If you get me very well, I said this 3 naira is wrong because this is the opening rate. In this question, opening rate in line with IAS 21, opening rate is the exchange rate in which the parent company acquired the subsidiary or the new financial year. That means the beginning of the accounting period. Let me just use that word. The beginning of the accounting period. So here, IAS 21 now said when you buy an asset and you want to record it, IAS 21 says record it at the date of transaction. So if you look at it, it is January 2023, and that's the reason why we are picking this 2.5. That's the reason why we are not picking 3, we are not picking 2.4. You must recognize it that when is the transaction taking place, and this is 2.5, January 2023. So I hope everybody understand now where we got that 2.5. Now let me now move to what Madam said now. Now, if you want to solve your question, where am I? Where are we now? Okay, this is where we are. Now, if you want to translate, I've said it before. Let me say it again. Because that transaction is a foreign transaction. Who is this again?
Mr. Deba, you're mute now.
Sir, mute everybody from your side.
I think that's what we do. I think maybe he's on the road. He has forgotten that he's not muted. So now let's continue. We'll take people will raise up their hand if they have questions. We have a long way to go. So now, when we want to translate any transaction in line with IAS 21, you must translate that currency from foreign currency to your functional currency. Now, how will you know that a transaction, and that's where Madam is going, that how will you know that you are going to divide? How are you going to times? That's one of the issue of IAS 21. That okay, how am I going to divide? Am I going to divide or you are going to times? Because I want to translate this 150 million. I want to translate it to my functional currency. So IAS 21 gives you a guide that this is what you are going to do. You go back to your question. Everybody listen very well. If this exchange rate is 1 naira or functional currency, so if this exchange rate is 1 naira, is it naira? Sorry, if exchange rate is 1 unit to the foreign currency, if this how this English, how am I going to put this English? This English. Okay. Everybody, let's exchange rates. When you now look at it very well, you now check it very well that which one is in 1 unit. Which one is in 1 unit? If the foreign currency is in 1 unit, you will multiply. Please, if you want to note it down, you can jot it down. Let me quickly write it in notes here. Let me write it here so that everybody will get it. Let me write it. NP. If exchange rates is expressed in 1 unit of foreign currency. Let me write it here so that everybody will get it. Then we will multiply. Let me do it like this. Let me do it like this. Now, I'll now copy that same thing again. Let me copy it. Okay. But if exchange rates is expressed in 1 unit of functional currency. I know everybody understand what is functional currency now. The currency of the subsidiary company, that's the functional currency. Then we will divide. Full stop. So now, this is it. This thing we must cram it, and it's very, very easy. For you to understand ES21, you must cram this what I wrote. Cram it, you must cram it. Now let's go back to the question now. If exchange rate is expressed in 1 unit of foreign currency, we will multiply. But if the exchange rate is expressed in 1 unit of functional currency, we will divide. Now let's go back to the question. The 1 unit now, this 1 unit that we have now, is it in functional currency or in foreign currency? We can use the chat box. Okay, let me use this. If the one expressed in 1 unit, if it is foreign, if it is functional currency, can we use thumb up? But if it is foreign currency, can we use thumb down? Which one is the one that is expressed in 1 unit? The one expressed in 1 unit, yes. If it is, in case you did not get my question very well, if it is functional currency, let's thumb up. If it is foreign currency, let's thumb down. So that's what I want to get. Okay. So now let me explain it now. If you go back to the question, let's see this question together. The one that is in 1 unit is functional currency. Look at it. 1 GMT. GMT is the functional currency. Let me use another color so that it will not cause problem. Let me use another color. This one in 1 unit is the functional currency. Now, if you go back to our note now, which one? Let's go back to our note. Which one is in 1 unit? Look at it. This is it. If the exchange rate is expressed in 1 unit of functional currency, we will divide. This is the answer. This is the answer. Because the exchange rate is expressed in 1 unit of functional currency. This is the functional currency, GMT. So we will divide, assuming that they told us that okay, one USD is equals to on October 1, 50 GMT, on January 1, 70 GMT. They now put all of them 70 GMT, 60. This one, all this one that now change. But it is USD that is in one. This one, that's what you will be looking at. Which one has one? That is why yes 21 is saying which one has one beside it. It is this one. You know. You used to decide your, maybe you divide or you multiply. So when you look at this question now, you see that it is GMD that has one now, and you now ask yourself, okay, GMD has one. Is GMD, is it functional currency or foreign currency? GMD is functional currency now. Now, according to your notes, we said when it is one, when the exchange rate is expressed in 1 unit of functional, then we divide. So that is our answer. So can we react? If you now get what I said now, can we react? Please, let's react. Please, what is the functional currency? Functional currency, I think this person just joined also. Functional currency is the currency of the company. The company, Masakoko. Masakoko is the company. And when you read the question from the beginning, they told us expressly that Masakoko currency is GMD. So GMD is the functional currency. Then the foreign currency is the USD, US dollars. So Auntie Shade, please take notes. Please, let's take notes. So we are good to go now. We are good to go. Even Auntie Shade is now understand now. So now let's get it straight like that. Let's get it straight. So now we have made the adjustment. Look at the adjustment. They said we should use the exchange rate as on the 1st of January 2021, and that's what we use, which is 2 naira 50 kobo. Then we divide it because we knew that okay, IS21 says when the exchange is expressed in 1 unit, we should divide, and we have established that. Now, this is our cost. The cost that should be recorded is what? Is 60 million. And what are we going to do? We pass the journal. Let's say, look at the journal. Look at the journal. But let's take it one after the other first. Let's don't rush. Now, depreciation. We have established it that depreciation should be charged over the useful life of the asset, which commences when January 1st, 2023. Abi? Hence, only 9-month depreciation is required to be charged. You know, we said it that time that the end of the accounting period of the company is what? September 30th, 2023. Then the asset was purchased on when? January 1st. So from January to September, it is 9 months. So it's only 9-month depreciation will be charged. And then what are we going to do? You say 60 million, which is the cost of the assets. This is the cost of the assets in GMT, divided by 10 years, the useful life times 9/12. When you press your calculator, 9/12 is the same thing as 75% times 9/12. Don't let me use now. Let me don't use this percentage. Let me use times 9 divided by 12. And the carrying amount is 55.5 million, which is 60 million minus 4.5 million. So how do you get this 60 million? This is the cost when we converted it to GMT. Then depreciation of what? Depreciation of 4.5 million. Then cost minus depreciation is what? Is carrying amount, which is net book value. So we have settled depreciation too. So now, if you now go back to that question, you remember that there is an error. Let's quickly go to the question before we move. Let's go. There was an error in this question. Now, in the question, what did they recognize? They recognize how much? They recognize 150 million divided by 3 million. If you remember, the exchange rate as at this date they use $3. So 150 divided by $3 is $50. So in the question, they recognize 50 million. But the correct thing is 60 million, it's not 50. So what are we going to do? We pass an adjustment. And this is the adjustment. Look at it. PPE, the one they did before was 50. But the correct one we calculated now is 60. So the difference is what? Is 10 million. Please, let's get this in very well. Assets supposed to be 60 million. But the one we did before was wrong. It was 50. So there is a need to increase the asset by 10 million. So we will debit the asset, we credit the payables. So this is the journal. This is the journal we are going to create. Debit PPE with 10 million, we credit PPE with payables. Because what they did before is that they debited PPE with 50, then they credited payable with 50 million. And whereas we have established now that it was wrong, it's supposed to be 60 million. Now let's quickly settle the exchange difference. Now, if I settle the exchange difference, then I can now take one or two questions in case. But I'm very sure. Let me look at people. People are following me now. People are following me. But people are getting it. So let's quickly settle the exchange difference. No, 150 million. Please, let's take it one after the other. Don't rush. Let's take it one after the other. Exchange difference. Now, what is exchange difference? Look at the exchange difference. Now, the exchange difference recognized before. Let's check. Now, look at the exchange difference recognized. Debited to retained earnings, 12.5 million. Then what we did is that wrong or right? We discovered that it was wrong. It was wrong. Now, we will now do the correct exchange difference. Now, what is the correct exchange difference? Let's look at it together. Let's look at the correct exchange difference. Now, exchange difference arose on 1st January 2023 when the payment was made March 31st, 2023. This should be charged to profit or loss instead of directly to the equity. They did what? They posted that exchange difference of 12.5 to equity, which is retained earnings, and that's what they told us. And it is wrong. It's supposed to be expense. Now, the correct exchange difference is what? Is how much did they settle that asset? How much did they settle that asset? Now, let's see. You know, they paid how much? 150 million. Now, let's go back to the question. Let's take it one after the other. They said, on 1st January 2023, Masakoko acquired some specialists from the United States for 150 million. And the payment was settled. The payment of the equipment was made on March 2023, March 31st, 2023. That is when the payment was settled. So they made the payment when? They made the payment on 31st March 2023. Now, you now ask yourself, what is the exchange rate on 31st March 2023? What is the exchange rate? You ask yourself. You now go back to your question. What is the exchange rate on March 2023 when the payment was settled? Let's go back to the question. This is it. When the payment was settled on 31st March, look at the exchange rate. $2.4 million, $2.4. Can you see that the exchange rate has changed from 2.5 to 2.4? So when you want to settle that liability, when you want to post that in your financial statement, you use the exchange rate at the date of settlement, which is 2.4. And that is what happened here. Therefore, the exchange rate, the correct exchange rate is 150 divided by 2.4. This 2.4 is the exchange rate as at 31st March when the payment was settled. So there is an exchange loss of what? Of 2.5 million. How did they get 2.5? This 6.5. This 6.5, which is the payment that was made to settle the assets, minus the cost we recorded. This cost of 60 million, the amount we bought the assets when we translated is 60. This is the amount we settle it on the 1st of March. So the difference between this and this is 2.5 on settlement date. So this 2.5 is the correct exchange difference. The correct exchange difference is 2.5 and not 12.5 that they did. You know, according to the question, they recorded what? Let's go back to the question. They debited 12.5 to retain earnings as their own exchange loss. Abi? And it is wrong. It is not 12.5. It is what? It is 2.5 because we have calculated it together now with the correct exchange rate. So it is 2.5 and not 12.5. That is number one. Do we get that? But before I ask that question, okay, people get it. People get it. So before I answer that question, let me quickly establish this. How do we get exchange gain or exchange loss? How do we determine exchange gain or loss? Because that thing, nobody will tell you in the exam that it is an exchange gain, it is an exchange loss. You must know it by yourself. Just like when we did multiply. When are we going to multiply? When are we going to divide? You know, we settled that one. That this madam reminded me. So that I quickly, and that's where I'm going. I need to explain this exchange loss. How do we get exchange loss? How do we get exchange gain? How do you know that, okay, this is exchange gain, this is exchange loss? It is very, very simple. It is very, very simple. Now, this is it. When we want to pay, when we bought this asset, this asset was how much? 60 million, right? Yes. I'm the one asking question, I'm the one answering it. The asset is 60 million, which is the cost. When we translated 150 divided by 2.5, we get 60 million. Now, what is the accounting entries of this 60 million? We are going to debit assets. We debit our equipment account, which is assets. Then we credit payables because we have not paid. We have not paid that money. You credit your payable. And that's why they said and a liability for that amount is recognized. Liability, let me put it in bracket, payables. Let me put it, payables. You credit your payables because you have not paid. Assuming this money has been paid immediately, we bought it on January 1st, 2023, and we paid immediately. We will debit assets, we will credit cash or bank. But since we have not paid, we paid it when? We paid it on March. We paid it in March. We did not pay it in January. So on that day, that first day, we will credit payable. So when we credit payable, now this 60 million is what we're supposed to pay. In our payable, is 60 million we're supposed to pay. However, when it is now March, due to exchange difference fluctuation, we now pay 62.5 million. Instead of us to listen, everybody, instead of us to pay 60, we now pay 62.5. Is it favorable or unfavorable? Let me ask that question. Is it favorable? If it is favorable, let's use thumb up. If it is not favorable, let's use thumb down. Okay. Please, if you are, let me ask the question again. No, please, I'm supposed to give you now example. Now I want to give everybody on this call. I want to give everybody, even though I don't have money, that some people can give me money. Go. Let's use example. I want to give everybody money, 100 million tomorrow. Now, multiply by how many people are on the call? All of us, we are now 120 something now. Now, tomorrow, now, I wanted to pay you dollars. So now, exchange rate that now changed tomorrow. Instead of me to pay you 100 million, everybody, I'm now paying you 120 million. Is it favorable to me or unfavorable to me? So if it's favorable to me,
let's use thumb up. If it's not favorable, let's use thumb down. Okay. People now get it now. Yes. So it is not favorable to me. It is not favorable. So since it is not favorable to me, why is it not favorable? Because I am paying more. That is it. That's just it. This IS21 is simple. When people think that IS21 is hard, it's hard in IS21. All you need to do is just calm down. Just calm down. Take it one after the other. I'm supposed to pay 60 million to somebody. In next 3 months, I'm now paying 62. It's not favorable to me now. And IS81 now said, when something is not favorable to you, it is a loss. And that is why we call it exchange loss. An exchange loss should be what? Should be expense in the financial statement, in the statement of profit or loss, in the period incurred. You just expense it. That's the requirement of IS21. Shikina. I'm sure everybody now gets it now. The reason why we are calling it exchange loss, I'm sure everybody gets it now. So I'm very happy everybody get here. Thank you very much. Please let's stay together like that. So that is it. That is it. So now we are done with additional information one. So before we move to additional information, so I will take 2 questions. I can see 2 hands now. I will take those people question now. So, but before I take that question, let's quickly do the accounting entries, the error. Now, PPE, the PPE was supposed to be 50 million, was supposed to be 60 million. But Masakoko did what? They recognized 50 million. Something that's supposed to be 60, they recognize 50. So we need to add 10 to it so that 50 will become 60. That's why we are debiting asset 10 million. We are crediting payables. The journal entry is being correction of cost of equipment, right? Now, journal number 2, which is B, payables. When they recognize exchange loss, they recognize 12.5 million. If you remember this figure, they recognize this 12.5 million. And we concluded, all of us, it's not only me, we concluded that it was wrong. That is not supposed to be 12.5. It is what? It's supposed to be 2.5. Abi? Yes. So what did we do? We are going to reverse. We post a reversing journal. So when we want to reverse, you now debit payables. So when you want to reverse something, you do the opposite. So you debit payables, then you credit retained earnings. Because that exchange difference, it has reduced retained earnings before. So we need to increase it back. So you now credit retained earnings, you now debit payables. That is the reversal. Now, working note C, journal 3, is recognition of correct exchange difference. So the correct exchange difference is 2.5. So IS21 says we should expense it in the profit or loss in the period incurred, Abi. So this is 2.5 million. This is the correct exchange rate, 2.5 that we calculated now. And we will credit payables. Why the last one is what? Is this reversal of depreciation overcharge. The depreciation Masakoko recognized. We concluded that it was wrong, Abi. Yeah. Yes. We concluded that it was wrong. They charge a full year depreciation of 5 million. If you remember very well, please remember. Please, let's remember. They charge a full depreciation of 5 million. But when we corrected it, the correct depreciation is supposed to be 4.5 million. So they are overcharged. They are overcharged by 500. They overcharged by 500. So that 500, we will debit PPE by doing what? By increasing the PPE, then we will do what? We will reduce the profit or loss. We credit profit or loss. So being reversal of depreciation overcharge. So that is the correction of error. That is the correction of error. So all the error they did, I'm very sure that if you are not very, because I know I'm talking this from example that majority of us, we don't really understand journal. If you can explain this alone, if you can explain this equipment, I'm sure it is like 6 mark. If you can explain this something I said now, out of 6 marks, you earn 4 marks. This journal will just be 2 marks because you have already explained it. Why the journal? Please just take it one after the other. You will get the journal. When you are reversing, you do the opposite. When you are increasing, you do it. So that is it. So before we move to the next, additional information. Let's move. Let me take question. Let me take Mr. Kufamata. Mr. Kufamata, can you? Okay, did I? Okay, I've muted everybody. Let me unmute everybody. So okay, Mr. Kufamata, can you go ahead and ask your question? Okay, Mr. Kayode, I think Mr. Kufamata is not available yet. Mr. Kayode, can you go ahead with your question?
Thank you very much, sir. Sorry, sir, I want to ask, why is the payment for equipment not a monetary transaction? Because I believe that money was being paid for it.
Okay.
And there's movement of cash.
Okay, thank you. No problem. Okay, that's the only question, Abi.
Yes, sir.
No problem. So now let me quickly address it. Monetary asset, non-monetary asset. The only standard that defines it is IAS 21. Now, what is monetary assets? Monetary assets, these are assets that represent an individual or an entity to receive cash, a fixed cash. Please, let's mute ourselves. Please, let's mute ourselves. We don't have time. We have a long way to go. Monetary assets. Thank you, Mr. Julius. Please, let's mute ourselves. We don't have time. Monetary assets are assets that represent a right. A right to do what? A right to receive fixed amount of cash in the future. An example of monetary asset is what? Number one is receivable, bank balance, trade receivables, and the likes, loan receivables. That is monetary assets in line with IAS 21. If you agree with me that if you have a deposit, bank balance, if you have money in your bank, any amount you have, do you agree with me by on Monday, if you need that money, you go to the bank and carry your money, Abi? Yes. Now, if you have a receivable, Mr. A is owing you money, you sold a goods to him on Friday, and he said he will pay on Monday. And how much is he owing you? He's owing you, let's say, 50 million. On Monday, if he says he's going to pay 50 million, you are going to collect your 50 million. So that is definition of IAS 21. A right that an individual or an organization has to receive fixed amount of money. Your amount is fixed. The amount you want to gain, the amount you are expecting is fixed. And the examples are cash, bank balance, receivables, loan receivables. And if you think deeply very well, you know that, okay, this is monetary asset. Now, non-monetary assets, these are assets that did not give you right. You do not have right to receive a fixed amount of money. That's a simple definition of non-monetary asset. Don't worry, I have forwarded standard to you before. I have forwarded IAS 21 that I summarized in 2 pages or 3 pages. I will forward it to everybody tonight again, so that you will read IAS 21. So, non-monetary assets, these are assets that does not give you rights. that did not give you right to, or obligation if it is non-monetary, if it's monetary liability. Monetary items can be either be asset or liability. So when it's an asset, you have a right. When it's a liability, you have an obligation to receive fixed amount of cash, fixed amount of money. So that is simple definition. So if you look at it now, that equipment is a non-monetary asset. Is a non-monetary asset. When you want to sell your assets, your equipment tomorrow now, you have to negotiate. That person will look at you. You and that person will negotiate that. Although I buy this asset $150 million, that person will not say, let me buy it 140. Let me buy it 120. It's not fixed. The amount you collect for that asset is not fixed. You have to negotiate. But when it is monetary asset, the amount you are expecting is fixed. So that is it, Mr. Coyote. So the second question, let me take the second question. Mr. Wali is not available. The second person I can see their screen is Oladipupo Rashid. Are you available?
Yeah, thank you very much, sir. Good evening.
Good evening, sir. Good evening.
So what I wanted to ask initially, I sent it as a message on the group. So when you said we can generate a liability, I realized the liability is coming from the date of payment and is not explicitly stated.
I don't get your question again. Can you repeat it?
So, okay, from the journal treatment, we've been using payable, and in your explanation, you mentioned the payable is coming from that is stated explicitly stated in the question that a liability is generated. So I realize the liability is coming from the date of payment because it's not paid at the date of purchase. Is that date difference that is created that caused the payable, not that it is expressly stated that?
No.
Are you with me?
Okay, I get your question. Don't worry. I've get it. Don't worry.
Okay.
I get it.
All right. Okay. Thank you.
I got your question. So what he's trying to say, I got his question, was that transaction, immediately you buy an asset, and let's get it straight. In case maybe what I said was misleading or something. We bought an asset on 1st January 2023. Abi? Now we have not settled that amount on 1st January. That 1st January, when you want to record that transaction, automatically it has created liability. Since you have not recorded it, since you have not made the payment, you have not made the payment, and that is accrual basis. If you remember your accounting, your ES1, your fundamental accounting, accrual basis, you buy an asset you have not paid. So on 1st January, you create a liability, you recognize a liability. Now, on the date of payment, and what is the accounting entries? You debit the asset, you credit the liability. But when you now settle the assets, you settle the payment for that particular asset. Even though it's the next day, on that next day, what are you going to do? You debit the liability and you credit your bank because you have made payment. So immediately you debit your liability, the liability cancels. That means you are not owing again. And that's what happened here. So please again, let me just say it. Please don't let us get it twisted so that we are not going to get confused. Let's just understand accounting principle. So let me take the last question so that we continue. I only give 3 minutes to take question. So let me take the last question so that we can continue. Mr. Audu, can you go ahead with your question? Mr. Audu Francis.
Yes, sir. Thank you very much. Good evening, sir.
Good evening.
My question is almost in line with the recent question being asked.
Okay.
Mine is on the reversal of the loss and the exchange lost there, that 12.5. Since it's at the date of settlement, I thought we are not to debit payable, rather we debit cash.
On the date of settlement?
Yes.
Okay,
why debiting payable, since we have already settled it and it's as a result of the debt or the owing that gain, that loss arose. So why not cash?
Okay.
That is my
Now,
question.
this wrong exchange rate. Okay, I've gotten your question. Now, the first thing before we post a transaction, I usually tell people what I personally is that you need to understand the first the initial entries. The initial entry is that now when the exchange difference was posted, when the exchange loss was posted, how are we going to post it? That's the first question. When the exchange loss arise, what is the accounting entries for exchange loss? That means this 12.5. What did they do? They debited payables and credited earnings. Right? They did what? At initial stage, they debited retained earnings because we are told in the question, look at the question here. We have the question here. They said the sum of 12.5 has been debited to retain earnings. So they debited retained earnings. Then they credited what? They credited payables. So when we are reversing now, we do the opposite. So that's why we reverse it that way. Then we debited payables. Then we credited the retained earnings. So we did exactly what they did when the payment was settled. Because when the payment was settled, when we paid that 60 million, what do? We debited our payables, then we credited our cash or bank. So please, let's get it that way, so that time is going. So let's move to impairment. Additional information too. Mr. Adigun, I can see your hands. Your question is noted. I'm going to come back. Just take note of it in your.
All right, sir. Thank you, sir. Thank you, sir.
Just take it in. Just put it in your notes. We will continue because we have an objective to finish this question by so time. So please just understand. Thank you, sir. So impairment. Let's move to impairment. Now, impairment. Additional information too. Impairment. Masakoko bought a warehouse on October 1st, 2016 for GMD $180 million. The warehouse. Now, please let's take note. When was the asset purchased? The warehouse was purchased when? On 1st
October 1.
Before the acquisition date. Please let's take note of before the acquisition date. Now, the subsidiary was acquired when? On October 1, 2022. That is our own concern. We are not concerned with this date. The warehouse is depreciated over 20 years with a residual value of so. So they now said on October 1, 2022, due to rise in property prices, the warehouse has been revalued to 210 million. And evaluation surplus of GMB 64 million was recognized. Evaluation surplus, our IAS 16. This standard is testing IAS 16 and IAS 36, which is impairment. So when an asset is revalued, IAS 16 says we should measure the asset using the revalued amount. Sorry, we should use the revalued amount. So now the asset has been bought 180 million since 2016. Now, due to rise in property prices, it has been valued to 210 million. Then, what does that tell us? First and foremost, we need to determine the depreciation, Abi. The depreciation is at this date till this date. So when we determine the depreciation, we deduct it from our costs, we get our carrying amount, then we now do what? We now compare it, our carrying amount, we compare it to 210 million to get our valuation surplus. However, they told us that a revaluation surplus of 84 million has been recognized. We don't have a problem to it. Let's move on. No transfer are made between revaluation surplus and retained earnings under Gambian GAAP in respect of depreciation. Now, that sentence, please let's take note of it. This sentence, they said no transfer are made between revaluation surplus and retained earnings under Gambian GAAP. However, in line with IFRS, is it possible we transfer revaluation surplus to retained earnings under IFRS? You know that they told us that in Gambian GAAP there is no transfer, but in IFRS, can we transfer revaluation surplus to retained earnings?
Yes.
That's a question we must ask ourselves. That's a question we must ask ourselves. Can we transfer surplus, revaluation surplus to retained earnings? Yes, we can. IAS 16 says it. There are some circumstances where you can transfer your retained earnings, your revaluation surplus can transfer it to your retained earnings, but it is under some circumstances. It's not expressly, it is under some circumstances. So now let's move on. Let's move on. Now, however, sorry, excuse me. However, there has been a slump in local property market in Gambia recently. So an impairment review, IAS 36, was taken on September 30th, 2023, on the consolidation date. On consolidation date, September 30, 2023. An impairment review was carried out. And the warehouse as assessed as being worth 60 million. Something that is worth how much before? Something that is worth 210 million. It has now dropped to 60 million. Can you see? Voila.
Yes.
Therefore, a charge of 90 million was made to profit or loss to reflect the difference in carrying amount and the carrying amount of the warehouse of 150 million before September 30th and the new value of GMD 60 million. So now this information is talking about what? It's talking about impairment. The asset was purchased in 2016, 160 million. Then depreciation is the useful life is 20 years, but on date of acquisition, they revalue the asset. It is now 120 million. They recognize revaluation surplus. Then we discover that we can transfer revaluation surplus to retained earnings under some circumstances. So now, on September 30th, the warehouse is now worth 60 million. Now, there is something I want us to note here. They said, therefore, a charge of 60 million, a charge of 90 million, which is impairment, as what has been made to profit or loss to reflect the difference in the carrying amount of 150 million. So this sentence, what I can deduce from this sentence is that they have made the adjustment for impairment. This 90 million, they have made an adjustment for it. Now, let's go back to our solution. Let's go back to our report. The report they say we should do now. Now look at let's look at what we are going to do now. Now, impairment. Now, first and foremost, oh shit, this Microsoft Word have started. How is this scatter like this? Now, on initial depreciation, 1st of October 2016 to October 2022. How many years is that? That's 6 years. October 2017, 18, 19, 20, 21, 22. That is 6 years. 6 years. So now to get our carrying amount. To get our carrying amount, we need to determine our depreciation. 180 million divided by 20 years times 6 years, that's 54 million.
54 million.
That's 54 million. Now, carrying amount on 1st October 2022. What is the cost? The cost is 180 million minus accumulated depreciation. Oh shit. Let me mute everybody so that will be. Let me mute everybody. So that if you have any question, we can take question. So let's go. Now, the carrying amount is on 1st October is arrived as follows: 180 million minus 54 million, which is the accumulated depreciation. This 54 million is the accumulated depreciation. Accumulated depreciation for how many years? For 6 years. This is the accumulated depreciation. A yearly depreciation is 180 divided by 20, which is 90, which is 9 million. So 9 times 6 is 54 million. That's the accumulated depreciation. Now, our evaluation surplus, we need to determine our evaluation. Sorry, this is 126 is our carrying amount. Fine. Now, evaluation surplus is revalue amount less carrying amount. 110 million minus 126. That is 84 million. So this is the 84 million they told us in the question. Remember, let's go back to our question again. They told us that 84 million, evaluation surplus of 84 million was recognized. If you remember, they told us that 84 million were recognized. This is how they got that 84 million that we explain now. Now, what is the accounting treatment? Evaluation surplus. You debit the warehouse, 84 million, then you credit the evaluation reserve. You credit the evaluation surplus reserve. Evaluation surplus reserve. So, which is evaluation reserve anyway. Now, they now told us that under Gambian gap, let's go back to the question again. No, this is our question. They said there is no transfer between evaluation surplus and retained earnings under Gambian gap in respect of depreciation. So what are we going to do? Under IFRS, it is permitted. It is permitted under IFRS. So we can transfer that 84 million. We can transfer it to retained earnings. What are we going to do? You debit your evaluation reserve, 84 million. You know, we have a credit balance before. Then you credit your retained earnings, 84 million. That's the accounting treatment. Also, there is a need, but it is good to stop here. Let's stop here. Let's just stop here. This is it. There's another information here, but that information we don't really need it. Or else you just find a problem to ourselves. They said this second paragraph, there has been a slump in local property markets in Gambia. So an impairment review has been taken as of September 30th. The warehouse is assessed to. Now let's ask ourselves. As at September 30th, what is the carrying amount? As at September 30th, the realizable value is now 160. It's now 60. Therefore, a 90 million was charged to the profit or loss to refer the difference between the carrying amount of the warehouse of 150 million before 2023. Before 2023. So before 2023, like during the year, the surplus value, the revalued amount has dropped, and that's what I want to establish here. According to that sentence, the revalued amount has dropped from how much? How much was the revalued amount before? 210 now. Is it not 210? Yes. This is the revalued amount. This 210, it has dropped from this 210. It has now dropped to 150. That's what they are telling us here. It has dropped from 210 to 150, which is 60 million. Now, after that, it now dropped from 150 to 60 due to a slump. I can say a drastic slump, a drastic slump in local property in Gambia. That asset from 210 that was revalued to, it has dropped to 150. In which the 60 million they are talking about. Then 90 again, 150 minus 90. Now the asset, the warehouse is now worth 60 million. After all this story we have said, the worth is now 60 million. But they now told us that, therefore, a charge, please English, a charge of 90 million was made to profit or loss. That means they have accounted for this 90 million. They have accounted for it. This 90 million has been accounted for. That is the English I want to say. Therefore, a charge of 90 million GMD was made to profit or loss to reflect the difference between the carrying amount of the warehouse GMD before 2023 and the new value of GMD 60. So this 90 million has been accounted for. That's what they are telling you. And if you go to your question, let's go back to this is our question now. Other warehouse that we are talking about is already included in this PP. Please, that's what I want to explain. That warehouse, all those calculations, all these 60 million, all this, that, they are already in this PP of 208. And they have told us that they have accounted for it. And if you look at it, let me ask a question now. We are going to react. As how they calculated the depreciation, are they right or wrong? If they are right, let's use thumb up. Let's use thumb down if they are not right. As they accounted for it, are they right or wrong? Are they calculated their revaluation surplus? Are they right or wrong? Some people are saying they are wrong. Please, let's look at it very well. They are not wrong. They are right too. They are right. The worth of the asset is what? They said the worth of the asset is 90. It's now 60. We did not hear you, sir. Is my people cannot hear me. Please, you can hear me now. Please use your please. Is your network? Please hear me, please. Please hear me very well. Please hear me very well. So please, let's get it very well here before we move on. They told us that, let's go back to that question. They bought a property for so. They calculated the depreciation. They did that. When we check it, they are correct. This 84 million, they are correct. We look at it together. When we solve it, when we prepare our report, maybe we showed ourselves here that this 84 million is correct. So what they did was correct. The only thing that they did that they did not do very well, and it is in line with Gambian GAAP, no transfer was made to do what? To evaluate, to reflect, no transfer was made to transfer evaluation surplus to retained earnings. But in line with IFRS, in some circumstances, you can transfer. And that was what we did. We debited the evaluation reserve, we credited retained earnings. But this second one, This second one, they are saying they did an assessment, an impairment review. Now the warehouse is now 160. The warehouse is now 60 million. From 210, the warehouse dropped to 150, and that's what they said. This 150. From 210, it dropped to 150. Then when it now dropped to 150, they now do the last assessment, which is as at September 30th. they now assess that the warehouse is now 60 million. So 150 minus what? Minus what will give us this 60 million. So this is the carrying amount. Sorry, I said carrying amount. This is the recoverable amount. Recoverable amount. Remember, yes, 36. What are we comparing? Carrying amount and recoverable amount. This is the recoverable amount, 60 million, as of September 30, 2023. Now, the carrying amount is 150 before September 2023. Let me highlight it so that everybody will get it though. Before September 2023, the carrying amount is now 150. It's no more this 210 again. No. It's now 150. But the recoverable amount is now 60. So 150 minus 60 is this 90. And this 90 was made to profit or loss to reflect the difference. It has been accounted for. So what I'm saying is that in this working note, this relevant note 2, all what they did, they has accounted for it. What are we going to do? We will just leave it and move on. Since they said they have accounted for it. So that's what happened in this question. So that is impairment. What they did in this impairment is not much. The only adjustment we made is this transfer of evaluation surplus to retained earnings. That's the only adjustment. Then we can now move to financial instruments. But okay. Let me quickly ask Adigun, Mr. Adigun. His hand is up this morning. Let me take his question. Then I will take Auntie Tiwalade. Let's quickly take those two questions. So I will move to financial instruments. Time is almost going. We have 7:30. This question which question are we solving? Please. If I'm the one taking you, please always check your group. I've sent the question to your group. The question is in your group. The question is November to May 2024. That's the question we are solving. I've sent it to your group so that you will see it in advance. So that if you join halfway, you know that okay, this question we are solving. So, madam, this the question May 2024 question 1. So, Mr. Adigun, can you mute yourself? Can you unmute yourself? Let me quickly take your question. So our time is going. So
hello, sir.
Hello.
Good evening, sir.
Hello. Yes.
Yeah, good evening. Yeah,
Yes.
sorry, please. I just want to refer back to that exchange. That question. That question that you're talking about, how will you divide and how do we multiply? So in my own understanding, I just want to ask if I'm correct, because I just use my own dimension, that can we say like this, that if foreign currency is 1, multiply, that's direct. And if foreign currency is less than 1, we divide.
Okay, that's your own understanding. It's good. That's your own understanding. It's good. It's fine.
I'm just trying to.
It's fine. In that case, though, it is even simpler. If foreign currency is 1, we multiply. Abi, what did you say?
Yes, we multiply. That's direct.
Just like my lecturer, one of my lecturers, you say there are so many ways to die. Nobody will die by the grace of God. I think there are so many ways to die. Some people, it is strange. Some people, so there are so many ways. So you can take it anyhow. Just make sure you understand. Thank you, Mr. Sodi. Okay, Auntie. All right. Thank you, Auntie Tiwalade.
Good evening, sir. Please, can you hear me?
Yes, I can hear you, man.
Okay, my question is this part where we did the impairment.
Yes.
So my question is, after the evaluation of 210.
Yes.
And they said they did an impairment test around September 2023.
Yes.
So I thought we are supposed to get another carrying amount within that period. So okay, instead of using the 150, I thought that's my own thinking. So
okay. When yes, okay. Okay, that's your question, right? That's good. So what actually happened? The way they like constructed that sentence, if you look at it at a glance, you will know that there is an issue in this. Instead of us to tell us, but if you go back to that question, let me share my screen. The last revalued amount was 210. Now they now quickly told us that as at the end, though, at the end of on consolidation date, the warehouse is now 60 million. Naturally, you know that the impairment should be 60 minus 210. So we get our, but they now told us that therefore a charge of 90 million was made to profit or loss to reflect the difference between the carrying amount of 150 million. So if you now look at it that wait to a charge of 90 million was made. 210 minus 60, it is not 90 now. So sometimes, although I know exam pressure, I've been in so many exams, I know exam pressure. But when you sit down and look at this sentence, this additional information, you get it that they revalued that asset 2 times. Number one, they revalued it on 1st of October 2022, which is 210. Now they now revalue it again. See it to between the carrying amount of the warehouse as at 150 million before September. Can you see? This one is on September 2023. The realizable amount is 60, but the carrying amount before that date is 150. And the revaluation, so the revaluation amount we have before was 210. They now told us that the carrying amount is now 150 before 2023. So instead of them to shift this sentence up so that we understand, so the way they constructed that in the, but if you calm down, you know that this is the carrying amount before September 2023. Before. So invariably, the warehouse has dropped due to slump in property, in prices. It has dropped from 210 to 150. Because they told us here that the carrying amount is 150 before September 2023. Then on September 2023, that day, they now did fair value less cost to sale. The amount they are going to realize, they now see that it is 60. So the carrying amount on September 30 is 60. But before that date, it is 150. So they now did what? Before it was 150, but now it's 60. So if you compare this amount, you know that there is a revaluation, there's an impairment of 90. And they told us that it was made to profit or loss, which has been accounted for. So that is what actually happened. So the question is quite turning and the likes. So, but if you read it very well, you now see that, okay, this is what they are saying. Hope everybody now get that sentence now, so that we can move on. We don't have time. Okay, thank you. So Aditi Warabi, I think I have answered your question. So
yes.
All right, no problem. But yeah, let's go on. Financial instruments. Financial instruments. I think we can quickly run. If we are done, we are left with how many? 2. Okay, 6:30. We have 1 hour to go, so that your SFM lecturer is not going to call me again today. Last week they called me that please do, but today I don't want him to call me, so that at least we will be done before 7:45. So that we are not going to reach 8 here. Now, financial instruments, additional information 3. Now, the standard that talks about financial instruments is what? IAS 39. Sorry, IAS 39. It's also IFRS 9. Formerly IAS 32 and IAS 39. So IAS 32 and 39, IAS 32 deals with classification, while IAS 39 deals with presentation and measurement, recognition and measurement before. But now IAS revised IFRS now that deals with financial instruments is what? Is IFRS 9. So now let's read the question together. On 1st April 2023, That means during the accounting year. During the accounting year. They said Masakoko bought 5 million shares in local quoted company for GMD 7.7 per share. He bought 5 million shares on 1st of April. Now, what did they tell us again? Continuation. This represents 3% holdings. 3% holdings. You know, when you buy 5 million shares, you know, it is possible you can take over the company. It depends on the shares, the issued shares of that company. And that's why they told us that this represents 3% shareholdings. And so what they are telling us is that shares that he bought is an ordinary investment. Is an ordinary investment. Please, ordinary investment. That 3%. Since it is not more than 20%, if you remember, if it is more than 20%, it is what? If it is more than 20%,
Investment in associates.
Thank you. So you have been at, so that's the reason why they give us that information. So that this is an ordinary investment. And an ordinary investment should be accounted for in line with IFRS 9 financial instrument. So the intention of the company is to hold the shares until December 31st, 2023, and then sell it and sell them for a profit. So the business model for this asset is what? The business model is that you should hold it, then sell it for a profit. So his intention is to sell, is to hold, then sell it later. So, and IFRS 9 discussed what? He said, when you have a financial asset, this asset bought is a financial asset. Is financial asset. Please, let's take note. It's a financial asset. It's not a financial liability. So now, financial assets can be measured. Measurement of financial assets. Number one, it can be measured at amortized cost. It can be measured at fair value through OCI, and it can be measured at fair value through P or L. So how are you going to know maybe it's at amortized cost or through OCI or through this? Is a business model and SPPI test. SPPI test. That's IFRS 9. I've gathered some notes. I will send IFRS 9 notes to you this night. Just a summary that we can at least manage, because exam is very close now. We can't be reading like 70 pages or 20 something pages, and I will send an IFRS summary for you too, so that it will be very easy. Now we have established this now, that this investment is measured at fair value through P or L. Why? Is because the business model is to hold it, is to sell for profit. Is to sell for profit. That is it. So the business model is to sell for profit, and we'll measure it as fair value through P or L. So this is not IFRS 9 class. I just want to brush through it. So now they told us that the shares have been recognized at cost, okay, in the statement of financial position, which is correct. Is correct in accordance with Gambian GAAP. That is in line with IFRS. Now, when you buy an asset, you measure it at cost. That is fine. Now they said the market value of the shares as at September 30th, 2023, the market value as at the date of consolidation, the date of reporting, was 12.5. So invariably, the share has increased. The shares that was bought when? That was bought on April 2023 for 7.7 has now increased to 12.5. So there is a gain. The share has increased. The market value of the shares has increased. So now we are going to recognize that fair value increase. We are not told that he has sold it to, but this fair value increase, which is a fair value gain, we will recognize it. And they now told us that under Gambia tax rule, income tax is chargeable at 20% on accounting profit recognized on sale of investments. Income tax is charged under Gambia tax rule. Income tax is charged at 20% on accounting profit recognized on sale of investment. So now that is what they are talking about. So this 20%, it will create what? It will create deferred tax liability. So there's something I quickly want to say. Whenever you are solving a question, although I don't do it normally, it's usually in ACCA. In fact, my lecturer told me especially that whenever you are solving any question, whether it's a group account, and they now give you tax rates, please think. And that thought that should come to your head is deferred tax. Because whenever you are calculating shares, fine, you are calculating shares, you are doing this, you are doing that. Fine, inside in this question, they are even helping us. They tell us that tax rule. There are some questions, they are not going to tell you anything. They will just say income tax in Gambia. Income tax is charged at 20% on accounting profit. So, but what I want to explain to everybody is that you should take note that this creates deferred tax. That is where deferred tax comes in. Deferred tax comes in. So now let's go to the solution. And before I started the question, before I started the class, somebody asked what is deferred tax. And let me quickly browse that. Although IAS 12, somebody has muted again. IAS 12. Okay, I've unmuted everybody. IAS 12 is the standard that talks about income tax, especially deferred tax. So, deferred tax, we have two types of deferred tax. We have deferred tax assets and deferred tax liability. These are tax that arise as a result of temporary difference. And let me just cut the long story short so that we can move on. Let me cut the long story short. Now, when you are preparing your financial statement, you prepare it with IFRS, right? Yes. You prepare your financial statement in line with IFRS. There are so many transactions you record, you analyze based on IFRS. Now, at the end of the year, you are going to have a profit or loss. Majorly, the sole aim of the business is to have profit. So now when you have a profit, you will pay tax. Now, normally, your tax consultant, you prepare an income tax for you. You just pay. You go ahead. However, the tax authority will come back. There are some expenses you will incur. There are some income you will incur that the tax authority will not agree with you. We have temporary difference and permanent difference. There are some permanent difference, which are what? Depreciation, fines, if entertainment, they are permanent difference. Whenever they see it in your financial statement, they will disallow it. That who is allowing you to do this? In tax, we did not recognize this. So the difference between how the tax authority sees your financial statement and how you, as an accountant, in line with IFRS, what you see in your financial statement is what creates temporary and permanent difference. So temporary difference are what arise in which there are something that, as a result of time, this year, the tax authority might allow you, although they might allow you that, okay, next year we are going to tax you, or they tax you this year, next year you now realize that thing. So to just cut the long story short, temporary difference is something that arises as a result of agreement between tax authority and the accountant. So it will create temporary difference and it will create a deferred tax asset or deferred tax liability. So now, before we start solving our question now, they told us that income tax is charged at 20% on accounting profits recognized on sale of investment. So when you sell an investment, income tax that will charge on it is 20%. But let's stop with this question. Let's go to our solution now. So we are going to see how it is done. Now, financial instrument. Let's go with it together. Under FIS 9, financial instrument must be classified based on the business model. I said it earlier, right? For managing the financial assets and the contractual cash flow characteristics. That is CCC or SPPI, solely principal and interest test. So that's how you account for your IFRS 9. In this case, the intention is to sell the shares within a year for a profit. That's the intention, indicating that the business model is to hold the financial assets. So since we are going to hold and sell, is it? No, it's to sell. Is it going to, are we going to hold? No, we want to sell. It's to sell the assets. So now, for trading, to hold the asset for trading, okay, it's my Excel is. And later sell. Let me put it like that. And later sell. So financial assets held for trading are classified at fair value through P or L. Now, at initial recognition, how much is the cost? 5 million shares multiplied by the cost price of the shares, which is 7.7. If you remember, that's the amount we bought it, 7.5. So the total is what? 38.5. So what are we going to do? We debit our financial assets, then we credit our bank. Just like I said it earlier, when we are discussing about payables and the likes, where you buy an asset or you buy anything and you did not pay, you will create a liability, you will create a payable. That is by default, you will create a payable. Do you see it now that when they buy the assets, they buy the asset. For you to buy an asset, they don't buy shares on credit to you pay kia, you pay kia. So what did they do? They debit the financial asset and they credit the cash or bank with 38.5 million. Now, subsequent measurement, the market value of the 5 million shares are now increased to 12.5, right? Yes. So 5 million multiplied by 12.5, you get your 62.5 million. So there is a fair value gain. What is the fair value gain? It's 24 million, which is 62.5. The current value, the current market value of all the shares minus the costs we recorded at initial recognition. So there is a fair value gain of 24 million. What is the accounting entries? We debit fair financial assets, 24 million. We credit fair value gain. The fair value, we credit fair value gain. So now they already told us, and we know this, the condition of fair value gain. Changes in fair value is classified as fair value to P or L are recognized in the P or L. We know that. We know that. But if it is at fair value to OCI, it's not going to P or L, it's going to OCI. Please let's take note of that. Now, since they told us that that the income tax under Gambian GAAP is 20%, and under the tax law, there is a need to do what? There is the need to charge. When you want to sell an asset, it will create a temporary difference. I said temporary difference. Yes, temporary difference. Deferred tax liability. Yes, deferred tax liability. So now the next question is, how are we going to know deferred tax assets and deferred tax liability? Now, what is deferred tax liability? Deferred tax liability is like a liability. That means, it means the tax you will pay in the future. You might not pay it now, but you will pay it in the future. That is deferred tax liability. Why deferred tax asset is tax you will claim in the future. Tax you are required, that you have the right to claim, that you claim because you have made a loss or something. Deferred tax asset, you claim a loss. We have a loss, then you claim a deferred tax asset. But deferred tax liability, you have a gain, and that gain will not be taxed now, but it will be taxed in the future, because that gain, you don't have that gain now. So that is deferred tax liability. And how is it calculated? The temporary difference. What is temporary difference? The difference between what you want to tax. So this fair value gain of 24 million, that's the temporary difference. Just multiply it times 20%, the tax rate, you get your 4.8. So you debit your fair value gain. So this is your fair value gain of 24 million. You reduce it. That's why we are debiting. Then we are crediting deferred tax liability of 4.8 million. So you recognize this 4.8 million as a deferred tax liability. Why? Although we have recognized gain, but we have not realized it. It is in the future when we sell the asset. That is when we realize that gain. Because they told us, let me quickly go back to the question. They said, under Gambian tax rule, income tax is charged at 20% on accounting profit recognized on sale of investments. So, and according to this question, the investment has not been sold. Abi, the investment has not been sold, though. In fact, when are they going to sell it? They said the intention of the company is to hold the asset until December 2023. Can you see? This is when they are supposed to sell the asset, the intention of the company. But as at the date of reporting, which is September 30th, 2023, we want to account for it. We have not sold it though, but we want to account for it. So since we want to recognize a gain, a fair value gain, there will be a deferred tax, a temporary difference that will lead to deferred tax liability. That means when we sell the asset in December 2023, there will be a tax on it. And that tax, we are going to pay it in the future. We will pay it in December 2023. In the future, because accounting year might have ended. Accounting year would have ended. Let me know which month would have ended. And we want to account for it on this date. We are not waiting for December 2023. So that is how to calculate fair value gain on investment. I've seen something like this in ACCA, unrealized profit on consolidation. So they gave us that question like that. Unrealized profit in the year so year, and they give us tax rate, and that's how ACCA does. Immediately you see tax rate, you just go to your head that this is temporary difference, and this will create deferred tax liability or deferred tax assets. So when you are selling, when you are making profits or having a gain, deferred tax liability will arise. But if it is not a gain, if it's like you are making an expense, that will be a deferred tax asset, because you claim it in the future. So that is the treatment of this. So we have calculated it. This is the fair value gain. This is it. So we have recognized our deferred tax liability of 4.8. So that is the end of that question. So let me take one or two questions. Okay, I have only one question. That is good. So that we can move to the last additional information that we prepare. We move to our working note B before 7:30. So that will be. So okay. Auntie Jumoke. Okay. Have I muted everybody? Yes. Okay, I've muted everybody. Let me unmute. Okay, Auntie Jumoke, Auntie Oluwa Jumoke. Can you go ahead with your question? Hello, Auntie Jumoke. You can go ahead with your question now. Oh, Auntie Jumoke is not available. She's not available. We can't hear you. Okay. Madam Temitope Ononuga. Can you go ahead with your question?
Sorry, I didn't know my hand was up. Sorry.
Oh, yeah. Yeah. No problem. No problem. Okay. Auntie Jumoke is not available. What about Miss Omolara? Miss Omolara.
Good evening, sir.
Okay, Miss Omolara. Yes, good evening, ma'am. Can you go ahead with your question?
Yeah, I've been raising my hand since.
Hey, yeah,
As
sorry about that. I'm sorry about that. I didn't see your hand.
the group accounts, that is what I want to ask.
What did you say? I didn't get your question.
Question as related to the group accounts, most especially this for foreign subsidiary. I noticed.
Yes. Go ahead. Go ahead.
Okay, I just want to understand something as regard the rates, because I noticed that when we are being given, let's say, the balance sheets to consolidate, I want to understand, how do you apply the rates when you are giving the balance sheets or when you are giving the income statements?
Okay, we are getting there. No problem. No problem. No problem. Your question is noted. When we get there, we are in requirement A. And when we started the question, we went to the requirement. Requirement A said there are some wrong adjustments that we need to do. We need to adjust. And that was what we are doing. So requirement B, we are going to go back to it. So and I will remind you that, okay, this is what Mrs. Omolara is saying though. So okay. Let me take one more question. Auntie Abimbola again. Okay. Oh yeah. Go ahead. Yes.
Can you hear me, sir? So
yes.
I just wanted to clarify something here. I'm not sure. So it's just about the business model for recognizing financial assets. So I know that if you're holding it to maturity, you use amortized cost. If you're holding it if you have intention to hold and sell, it's fair value through OCI. And then if you have intention to sell, is fair value through profit or loss. But in this case, why are we using fair value through profit or loss, since the intention is actually for him to hold and sell it at the end of the period?
Okay, that's your question. And actually is a good question. That's noted. So now, this is what actually happened. If you go back to the question, we have to be very careful about this. Look at it. They said this represents 3% holding, Abi. The intention of the company is to hold the financial assets until December 31st, 2023, and then sell them for a profit, right? Now, if you look at it, the intention of the company is not to hold it. If you look at the requirement of IFRS 9, IFRS 9 says when you hold the financial asset and you want to sell it, sorry, when you hold an asset, and if opportunity, any favorable opportunity comes, then you sell it. That is when you classify at OCI. Please, let's take note. And that is the condition in this question. When you look, it's like a condition. If you look at it, you can see that this thing is supposed to be an OCI. And that is ICANN for you. ICANN sees students as especially in finance, you see, they see us as a professional. Let me include us, all of us, that please, you have to be very careful. If in this sentence, the intention is to hold the shares, and if any opportunity arises, they will sell it. But look at this sentence. They said the intention is the company is to hold the shares until December 20. Even there is a specified date in line with IFRS 9. If it is fair value through OCI, they will not give you. They'll just tell you that it's to hold and sell if there is a favorable opportunity. It is a double business model. If there is an unfavorable condition, they are not going to measure it as fair value through OCI. But if you look at it, there's even a date that until December 2023, and then sell them for a profit. So when you look at it, and if you look at the solution, it is for trading. They buy the assets is for trading. You have a specified date that immediately after that date, they will sell it for a profit. So it is not classified to OCI. However, if you look at it very well, you can equally say yes, okay, it can be OCI. But if you look at it critically, it is held for trading. They buy it specially for resale. If you look at that sentence, they want to sell it. But fair value to OCI is to hold. But if there is an opportunity, a favorable opportunity, they will sell. That's the difference. So until people, I hope you get that.
Yes, sir.
So and anytime again, let me add this. Anytime you have anything concerning this, and let me quickly chip this in. When you have a financial assets, which is not a debt. So financial assets, there is debt assets and equity assets. This shares purchase is an equity asset, right? Yes. It is an okay, Auntie Dimoke, we can't hear you because of your mic. Okay. Maybe it's because of something else, sir. So let me quickly chip this in before I forget. When you have a debt financial asset, that means when you buy a bond, when you buy a debenture, those are debt financial assets. So you can classify them as one, at amortized cost, at fair value through OCI, or fair value through P or L. However, when you have an equity financial asset, you cannot classify equity financial assets to amortize costs. Why? Because SBPI test will be failed. When you analyze that equity financial asset and you use the SBPI test, which is CCC test, it will fail. And what IFRS 9 says that whenever as a financial asset failed SBPI test, please recognize that fair value to P or L. So please, let's take note of that again. Please, let's take note of that. When you have a equity financial asset, that means sale or like when you buy shares, please, it can only be measured at fair value to OCI or fair value to P or L. You cannot classify at amortized cost. So that's what I quickly want to chip in again so that we will also be done. So somebody said there are questions in the group chat that I need to look. Is what?
Hello, sir.
Hello.
So sorry, sir. Sorry to budge in. I just need on what you just mentioned now. For debt financial asset and equity financial asset, the intention you mentioned for liability, is it the same for debt and is it the same for equity? So the maturity, sell and hold and sell.
Yes. So and that's why I will by the grace of God, this night I will send a note, a summarized note. I think it's like 3 to 4 pages on financial assets, so that we can all see all these things. We can take note of it there too, because we can't be treating financial IFRS 9. IFRS 9. If you have read it well, you know that one is Jama Agbapo, because it's very long, even edging and the likes. So just leave IFRS 9 in one place first. Because we are solving group account here, let's leave it. So let me quickly go back to your what you are saying is that when it is financial liability are measured, are classified in at amortized costs or fair value to P or L. So financial liability cannot be classified through OCR. So I will send a note, a very comprehensive note. I will send it so that you understand what I'm saying. Please, let's move to please, I cannot take any other question. Please, let's mute ourselves. Auntie Precious, do you want to say something? I think she just mute herself. She mute herself unknowingly. So let me mute everybody back. So let's continue. Let's go to our last additional information. After 7. Wow. Okay, we are going to be due before 7:45. Now, provision. So when I started, I said it that the reason why I want us to solve this question is 2 objectives. Number 1 is to treat foreign subsidiary. Number 2 is to use the opportunity to look at standard, because although my lecturer usually says that in final level, in professional level, you have only 2 options when dealing with standard. Standard are too much. If you count standard, if you count it one after the other, there are more than 30 standards. So how many standards do you want to read? And it's only in ACCA. That's when I know that they set a lot of standards. In ICANN now, they cannot set more than 5 standards. In fact, it's around 3. No, there will be more than 3. Let's say 5 or 6. So out of 41. So it's only somebody that has been reading since that you can say, okay, I want to be very strong in standard. What I usually advise people is that, please, just make sure you read standard based on presentation, measurement, recognition. Those are 60% of the standard. Is more deep. It's when you are doing ACCA. That's when you are going to see deep transaction. Deep. Example is lease. When you are doing this, they are just going to, in ICANN, they just explain lease, normal lease, and the like. Whereas there is still a sale and lease back. I've not even think ICANN have said sale and lease back before. But if you go to ACCA, that's what they are testing every diet when they want to test lease. So, and financial instrument too. When you look at financial instrument now, when you go to ICANN, I don't think they will set this topic edging. Financial instrument, they will not set edging. They will not set derivative assets. But if you go to ACCA, you cannot escape derivative and edging, cash flow edging, fair value edging. So that's the reason why I usually say, and the problem of ICANN is that you don't even know which standard will come out. So, and that's the reason why my lecturer usually tell us that in ICANN, focus on what you know will come out. We all know that number 1, group account will come out. Go and know group account very well. Foreign subsidiary, sub-subsidiary, investment in associate, fellow subsidiary, know it very well. You know that it's coming out. Ratio analysis, go and solve it. Beyond financial reporting, where is it? That's where we are moving to. Beyond financial, all those integrated accounting, all those ethics and the likes. Go and know it because they will come out. But standard, you don't know standard that will come out. So if you go now, you read the IFRS 9, you say you are King Kong. You read all the IFRS 9. ICANN did not set it now. What are you going to do? You said you want to read, you now go to IS 12. IS 12, you now read. ICANN did not set IAS 12. You go to IFRS 15, you read last time IFRS 15 did not come out. So that you see now. But what my lecturer usually advises, just know the basis. Know the basis of each standard. And that's why if you look at standard, all those summary, IFRS summary, read it. They are like 1 page or 2 page. Read it. When you read it, when I can test a question of 7 marks or 8 marks, I'm sure with the recognition and measurement and the likes, I'm sure you score 3/4. Even though you know those small ones. But if you say you want to be reading all the standard, standard are too much. Even let me just rest my case. Let's continue. So let's continue. Let's move to the last additional information, which is provision, IAS 37. And this last additional information deals with IAS 37 and IAS 38. Both of them, they join each other. So now let's go. On 1st October 2022, Masakoko signed an agreement with the Gambian government for exclusive rights for the next 20 years to supply Adire t-shirts to Gambia National Traditional Festival. You sign a right with the Gambian government. That is a right. So that right, in line with IAS 38, that right is like, so those copyrights, trademark and the likes. So it's an intangible asset. It's an intangible asset. It's an intangible asset for the next 20 years, and it has a useful life. So immediately you get in line with IAS 38, when you recognize an intangible asset, sorry, excuse me, you amortize it based on the useful life of that intangible asset. So that right is for 20 years. So you divide it by 20 years. So now let's go. The cost of buying this asset was 42.5 million, which has been recognized as intangible assets in Masakoko Limited Statement of Public Loss, which is fine. The cost for the 2 years, 42.5 million is fine. Under the term, the right of agreement, Masakoko has to replace all damaged t-shirts. All damaged t-shirts as at year end 20th period. So within those 20 years period, within that 20 years period, if there is any damaged t-shirt, Masakoko has the right to replace them. And that is where IAS 37 comes in. Provision. IAS 37 defines provision of what? As what? Provision as a liability with uncertain timing or amount. A liability that you don't know when you will pay or you don't know the amount. And examples of provisions there are so many. There are so many types of provision. We have the commissioning cost, which is also known as restoration cost. We have development cost. Sorry, there are so many examples of provision. Example of provision. So many of them. I can't even count. Restoration cost, environmental cleanup cost. Yes, environmental cleanup cost. When you have an obligation to clean up a particular area, you see those oil companies, they usually have an obligation to clean up due to oil spillage. So they have to recognize provision. So IAS 37 deals with provision. So however, before you recognize provision in your financial statement, there are some criteria you need to meet. So I'm remembering the rest now. Restructuring costs, onerous contracts. Those are examples of provision. Another one is court case. When you have a court case, your case is in the court, like a customer took you to court. So you must recognize provision. When you are probable, when it is probable that court you are going to lose it. So IAS 37, I've forwarded IAS 37 to your group. I've forwarded it before, like a 2 pages or 3 pages something. I'll forward all of them tonight again. So that's IAS 37. So they now said there is 40% probability that the eventual cost of the replacement damage will be 75 million. And that is measurement of provision. We have one-off event and an event that is not one-off. So when it is not one-off, you are going to use example is warranty, a warranty cost. When you have a warranty too, they are provision with large amount of transaction. So you have to recognize replacement costs. So you have to recognize replacement. So this deals with provision for warranty. So warranty, that's warranty. So they told us that there's 40% probability that eventual cost of replacement of damaged ticket will be 75 million, and 60% probability of cost of replacement of 50 million. So when you have a provision that is of large items, IAS 37 requires that you should use expected value method. Expected value method. That's the method of measuring provision with large group of items. So, however, for prudency, a provision of 75 million was made in the financial statement and debited to operating costs. So it is wrong. Let me quickly do what we usually do. This 42 million is the cost of the right, the intangible assets, which we all say that it is right. Now, there is a probability of 40%, 75 million, 60, 70 million. So they recognize this. They recognize these two amounts. And IAS 37 will say, no, you should not measure provision like that. Though. You should use expected value method. So Matakoko has a pre-tax discount rate of 6%. The replacement cost will be allowed for tax purpose 1/8. That's where we are going. The relevant income tax rate is expected to remain at 20%. So this information is deferred tax. Whenever we see an information, whenever you see an information, they now give you an income tax rate. They are telling you an hint. The hint is that you are going to calculate deferred tax. So they gave us this 8%. What is this 8%? What is this? Why is this one coming to my screen now? Where is this one coming from? So, okay, I know what I will do. Let me just do our shit. Oh, where are we now? Are we going up or down? Oh, shit. Look at this. Oh, I think we are almost there. Which question is this? This is handball. This is handball volleyball. This is November 2023. We saw last week. I think we should look at which wala is this now? Apologies, everybody. You can see that this is Wincho. Just go, Charlie. Go. We are there. We are there. We are there. So they give us a pre-tax rate of this thing is back again. Just go. They give us 20%. I said this information is deferred tax. Please let's take notes. They give us this 8% pre-tax discount rate. So there is something we must be very careful of. These 20 years, these 20 years, right? Although that's for amortization, but it is also time value of money. This replacement cost in 20 years' time, we should take into consideration of time value of money. So we have highlighted all we need. So now let's go to the solution. Let's go to the solution. So that we can now go to our solution B. Provision. Where are you coming? Let's do it like this. Now, in line with IFRS, International Financial Reporting, and according to IAS 38, a right is an intangible asset, and the cost of acquisition of the right, 42.5 million GMT, on 1st October 22 was correct. So, we said it together now that that's correct. That 42.5 is the cost, is correct. Now, provision for replacement cost. Now, before we move on now, I said something the other time that IAS 37. IAS 37 is provision, contingent asset, and contingent liability. It is a standard that discusses about provision. That whenever you have a liability that you don't know when you will pay it, or you don't know the amount that you will pay, you must recognize provision. However, there are some recognition criteria that must be satisfied. And by the grace of God, I think we are going to treat standard because I have exam this direct. I didn't even have much time to treat so many standards. So IAS 37 is a very interesting standard. It's a very interesting and straightforward standard. It's a straightforward standard. So when you have a replacement cost, IAS 37 says you should make sure that when you want to measure it, you should use expected weighted costs, expected value, or expected weighted costs. And how are you going to calculate it? This is it. That 40% times 75 million plus 60% of 50 million. See, these two costs that they gave us. You know, they gave us these two costs. They say there's 40% probability that the cost will be 75 million and there is 60%. So now, what are you going to do? You are going to use expected value. If you remember your PM, what you do expected value. So what are you going to do? You find 40% of 75 million times plus 60% times 50 million. You now add it together. That is expected value method. So that is expected value. So, and that is what we did in our solution here. 40% times 25 million plus 60% of 50 million. That's expected weighted cost. So it will be what? 30 million plus 30 million. So the provision we are supposed to recognize is what? Is 60 million. The provision we are supposed to recognize is 60 million and not what? 75 million. You know, however, for prudence's sake, a provision of 75 million was made. Abi, they told us, and it was debited to operating costs. This one is wrong. This provision is wrong. Is wrong. Let me highlight it as red. Please take notes. This recognition they made, it is wrong. So what are we going to do? We are going to reverse it. We are going to reverse it. So, and what is the accounting entries for provision? You debit provision expense in your P or L. You can look at them, they put it under operating cost, Abi. Then you credit your provision in your current liability. Now, for prudence's sake, we have established that this is an error. They are wrong. So we will reverse it. So how do we reverse it? You credit back your P or L. You know, you debit it before, you credit it back. So you credit back your P or L, then you debit your payables, your provision in your SOFP, your current liability. So what you did at first, you did the reverse, and that's how to post the reversal journal. What you did initially, if you understand what you did initially, post the opposite. You reverse that transaction. And that is what we are going to do here. So if you go back to our solution now, what did they say? Now, since that replacement cost is going to be in 20 years, because the right is 20 years, if you remember, it is 20 years, there is a need for a consideration of time value of money. Time value of money. So what are we going to do? We are going to discount. So that 8% they give us, this 8% they give us, they did not give us a just for giving sake. This 8% is for discounting. So we are going to discount to present value. So we are going to discount this amount to present value. So you just press your calculator. 60%, 60 million over 1 plus R. Your R is 8%. So 1 plus is 0. Raised to power minus 20. When you press your calculator, you get your 12.87. You get your 12.87. So at inception, the present value of that 60 million, which is 12.8, will be added to the cost of the rights. You'll be added to your intangible asset of 42.5 million. You add it to it. Then you now credit your provision in your SOFP. You credit your provision. That is at initial recognition. The initial recognition for that provision is that. So as at the end, then, as at the year end, 30th September 2023, you now do what? You calculate unwinding costs. You calculate unwinding costs. You calculate unwinding costs. Unwinding cost of how much? Equally, 8% of what? 8% of 12.87. So when you press your calculator, 8% of 12.87, you get a 1.029. You get a 0.1.029. So which is approximately 1.03. So you debit it as your finance cost in your P&L. Then you credit your provision. So this will increase your provision. You know your provision formerly was how much? Was 12.87. Abi? Your provision was 12.8. So you now use this this unwinding cost. This unwinding cost, you now add it to it. It will now give you 13.8 or 13.9 or there so. So, but this debit of this transaction, this one, what are we going to do? You debit it to your intangible asset. This is what they are doing here. Can you see it? Then you now amortize it over 20 years. Then you now get an amortization of 2.77. Then we get our carrying amount, which is 55.37 minus. Do you know our carrying amount? This is our carrying amount. This is it. You now deduct your amortization for that year. Then you now get your carrying amount for the intangible assets. So what are we going to do? So this is the provision for replacement cost under your current liability, which was what I was saying, that this is your provision as at the beginning plus your unwinding costs. Plus your unwinding costs. So immediately you did that, what are we going to do? We are now going to calculate our deferred tax assets. Just like I said it earlier, that when you have a gain, when you have an income, it will create deferred tax liability. But when you have an expense, it will create deferred tax assets. So that's your value. That's replacement cost, 13.9. You calculate 20% on it. So you debit your deferred tax assets, then you credit your provision. How much is our provision before? 13 points. Our provision is 13.9, all right? So we will credit our provision. Then we now do the last one. We do the last one, which is what? Which is to reverse the 75 million that they did, which was wrong. So which will debit our provision, they will credit our retained. So that is in conclusion, all treatment given above comply with IFRS to the date of acquisition of equipment, evaluation, and the likes. Investment in shares and ensures financial statements are not over. So this is 18 marks. All they want you to do is to write, to talk, explain. They want you to talk. They want you to talk. They want you to talk. So this is it. So before we now move to requirement 2, 7:26. We have a few minutes left to. And we have to solve B. Okay, B, all the adjustments we have made, we just incorporate it. I think we can use 15 minutes to do that. So by 7:45, we end the class. Do you have any question? I know there will be question. Do you have any question? Okay. Okay. Auntie Temitope, can you, okay, let me unmute you, yeah? Oh yeah, go ahead, please. Just 3 minutes so that we can go to B.
Okay, sorry. I'm actually not asking too much of a question. So I just want to know, please, how did you get the 1.03?
1.03?
Yes.
That is the unwinding cost, the finance cost, 8%. 8% of your let me show you. 1.03. This is it. Unwinding cost. At the year end, you calculate your unwinding cost. 8% of 12.87. This is it. I mean, when you press your calculator, do you not get that? At the same talk where did you get that? Okay. Do you get that? Our network has gone. No. Okay, people get it. Okay, you too, you get it very well. Okay, okay, no problem. That is it. When you press your calculator, you get it. Mr. Kayode has a question. Can we take this question? Is a question very fast? We are muted, that is why. Did I mute you guys again? Okay. Sorry, I've muted everybody. Sorry. Okay. Okay, Mr. Kayode, can you quickly go ahead?
Thank you, sir. Sorry. In fact, I don't know, maybe if it's possible, is that provision, just the calculation, not the explanation? The calculation, how can you just go over it again, sir?
Okay, let me use 1 to 2 minutes to go over it. Okay.
Thank you, sir.
So provision is very, very easy to calculate. Now, when you have a provision of one-off event, example of one-off event is that court case, litigation, when somebody file a complaint against you, and that court case is in the court, that court case is currently in court. IFRS 37 says you should recognize provision so that, but before you recognize it, you should go and get a lawyer, a professional lawyer that will tell you that, am I going to lose this case or not? If the lawyer tells that there's 80% sure that you lose this case, you recognize provision. And that provision is very, very, very simple. You just recognize it. But when you have a large amount of items, example is this warranty, this provision for that right. So I start saying you are going to use expected value method. That is also known as expected weight cost method. That means you want to estimate. So when you now estimate, you now estimate that 40% of those clothes are going to be damaged. And the cost is 75 million. And you also estimate that 60% is 50 million. So in their solution, in Masakoko financial statement, they now recognize 75 million. And we conclude that it is wrong. It is expected value method you use. So you say 40% times 75 million plus 60% plus 50 million. So when you plug this, when you press your calculator, you get 30 million plus 30 million, you get your 60 million. Now, since the provision is not now, it's in 20 years' time. So that is time value of money. There's a need to do what? There's a need to incorporate time value of money. And you now discount this 60 million, you discount it to present value. So how are you going to discount to present value? Okay, give me water. So when you discount to present value, you now use your discounting something. 1 plus r raised to power minus n. So that's why I use 1 plus r raised to power minus n. Multiply by 60, that's where you now get 12.87. So that is how you will get your, thank you. So that's how you get it. Then immediately you have something that has time value of money. You must calculate unwinding costs. If you remember when we do our foreign subsidiary, when we do our fellow subsidiary, we did something of unwinding costs, which is deferred consideration. When the parent companies promise that they will pay in so time, we did discounting, and we now did unwinding costs. So that is it. So hope you get that now. You can use your thumb up if you get that now. Okay. So now let's use remaining 15 minutes to go to our working note 2. Let's go to our working note 2 so that we can quickly balance our notes and do what? And just close shop for today. Before our SFM lecturer will come and carry. In fact, I'm supposed to finish this class by 7:30 so that I will allow you to rest. Because I know SFM, because I did SFM, so I know that, now your head will be hot. So let me quickly do as I can do so that by 7:45 we end this class, so I can rest for 15 minutes before you join SFM class. Sorry, excuse me. So now I'm going to my Excel now. This is your examination, something I did earlier. Now, this is it. So all the adjustments we made. Now, this is where we are going. Any asset that we debit, to increase an asset that we will debit is to plus. Because asset has a debit balance. Please, everybody, let's take note. Asset has a debit balance. Assets, expenses, they have a debit balance. While liability, equity has a credit balance. So for you to increase an asset, you will add to it. When you debit an asset, you now debit it again, you plus to it. When you want to reduce an asset, you minus it. So all the adjustment we did, and that's the requirement of requirement B. Requirement B is that what? Prepare a revised statement of financial position of Masakoko that will be suitable for consolidation. That means all the adjustment we did, we should incorporate it in the financial statement of the company, and we should do what? We are now going to translate. You know, the financial statement of Masakoko is what? Is in GMD. And the parent company is who? Who is the parent company? The parent company is Kabbalah. Is it Calabar or Kabbalah? Calabar. Okay, Kabbalah, Nigeria. So the parent company is using Naira. It's a Nigerian company. Why subsidiary is Gambia? So IFRS says you have to convert the financial statement subsidiary company. You convert the subsidiary company financial statement to the parent company, so you consolidate. So what are we going to do now? We go back to our Excel. So now the first adjustment we did, so we are going to be picking it one after the other. Let's pick it. The first adjustment we did was PPE, right? Look at it. PPE 10 million, right? And that's why I highlighted it, so that this thing will be very, very easy for us. PPE 10 million plus 500, which is 10,500, right? 10,500, which is 10.5 million. 10,500,000. So PPE always has a debit balance. So they now ask we should debit it. So let's do our thing in another way, the way we usually do our group account. So we add 10,500 to it. Add 10,500. Add it to it. Voila. And if you want to do it, you can see debit. You can put debit there. Debit 10,500. But our group account, the way we usually do our group account, we usually add and minus. And that's why I'm maintaining this. So that is number one. Number two, let's pick the second item, is payables. So we have a payable balance of 10 million. We have a payable balance of debit balance 12 million. So when you add these two together, 12.5, then you do this again, 12.5. So we have a credit balance 12.5, debit balance 12.5. So the balance will be 0. So there will not be any adjustment in payables. There will not be any adjustment in payables. Where is our payables? Where is it situated? Our payables is in current liability. So there is no any adjustment in payables. So you can put minus 0. Or we can put plus 0. Let's put 0. 0 is useless. Let's put it like that. There is no adjustment. Now let's move. Any item again, we have retained earnings and P&L. Please let's take note. Retained earnings and P&L, they are the same. Anything that goes to your P&L flows to your retained earnings. Do you agree with me? Yes. So anything that flows in your retained earnings is coming from your profit or loss. So look at it. We have a profit or loss of how much? A debit balance of 25. A credit balance of 12.5 plus 500. 12.5 plus 500 is equal to 13,000. Abi, 13,000 minus 25 is 10,500. So the adjustment we have to take care here is 10,500, right? Am I right? Can I see your top? Hope you understand how we get this 10,500. So 12.5 plus 500, making 13,000 minus 25. That's 10,500. So what are we going to do? We go to our Excel. Let's go to our Excel. We go to our retained earnings. So now, our retained earnings now. What are we going to do? We are going to credit our retained earnings. So for you to credit your retained earnings, we credit your 10,500. That means you are crediting your retained earnings. Hope you are fine. Yes, we are fine. Debit is small. It is credit that is very large. So we have that. So let's go. Now, impairment. Now, which adjustment are we going to take care in impairment? I think the only adjustment we discovered that this 84 million was correct. This 84 million, what they did was actually right. It was correct. But the only adjustment we are going to do is that in line with IFRS, it is permitted. We can transfer evaluation surplus to retained earnings. In some circumstance, we can. So from this 84 million, let's go back to our balance sheet, our Excel. Look at this 84 million. That 84 million, look at it. Evaluation surplus. And what we concluded is that we are going to debit our evaluation surplus. By what? By 84 million. Let's debit it back. Let's debit it. Then we want to transfer it to our retained earnings, right? So let's go to our retained earnings. So we want to transfer that evaluation surplus of 84. We now transfer it to our retained earnings. Equally, we go back to our retained earnings. We now credit it. We debit evaluation surplus. We credit this 8,500. So that is the adjustment for impairment. Let's go. We have done this. So we debit evaluation surplus. We reduce evaluation surplus. And that's why we use minus 84 in evaluation surplus. And we credit retained, we increase it, we add it. So financial assets. Now, financial assets, we classify it as fair value through P&L, right? They said they have recognized this 38.5 million. Which financial asset? This is it. We have debited this 38.5 million, Abby. Yes. Let's go back to our balance sheet. This 38.5, can we see that it has already been debited? Look at it, 38,500. Now, it is only fair value adjustment that we are going to make, which is the fair value gain. So what is the fair value gain? I think the fair value gain is 12,000. Yes, 24,000, sorry. The fair value gain is 24,000. However, there's a revaluation surplus. there is a deferred tax liability of what? Of 4.8. There's a deferred tax liability of 4.8. And we have debited 4.8 from this retained earnings. So 24 minus 4.8, that's 9.2. That's 19.2, sorry. Because this fair value gain was 24 million before. But we have reduced it here. So when we reduce it from this figure. So we are going to get 19.8. 19.8. So what are we going to do? Our financial assets. Our fair value gain is 24. Our financial assets, we increase it by 24 down. They told us that out of this 24, we are going to recognize deferred tax assets. And that's the reason why I said, when you are solving look account, leave one line. Come to your this line, this two line or one line. Put your deferred tax liability here. Deferred tax liability. So we don't have anything before, but now we have 4,800, which is 4.8. You know we have rounded off 1,000 up. So 4.8. Now, which one is going to our retained earnings? This is what is going to our retained earnings. So 24 million minus 4.8 will give you 19. So what are we doing? We are adding, Abby. We are adding this fair value gain to our P or L. We are crediting 19,002. Sorry, it's not 19,008. 19,002. So when you add this 19,002 plus 4.8, you get your 24,000 that we recognize as fair value gain in our financial assets. So let's do it like that. What else again? We are done with financial assets. Now provision. So what are we recognizing in provision? Number one is intangible assets. Now let's go to our intangible asset. How much was the intangible asset at the beginning? At the beginning was 42.5. That has been taken into consideration. This is it. Intangible asset. That we said, can you see it? It has been accounted for. So all we need to do now is to do what? Is to recognize the provision. The provision that we discounted. How much is it? The provision that we discounted, how much was it? Let's go back to it. This is it. We discounted provision of how much? This is it. 12.87. And we calculated amortization of 2.7. So all what we need is, we need 12.87 and amortization of 2.77, right? Yes. So 12.87. So let's go to our adjustment. 12,870. That is the provision minus intangible asset amortization. How much is it? Equally. I can't see it too. I've routed everybody because we want to be very fast. Amortization is 2.77. 2.77. 2.77. So that is 2,770. Okay, that is 2,770. So when we add it together, we are going to be fine. Current assets. Can you see some bonus mark in that kind of exam? I've said it. If you know about it, there are some bonus mark 8,500. There is no adjustment for it. Just put it here. You get your full mark here. Any question that you know that there's no adjustment for this thing now. What am I doing? What am I calculating? Okay, put it there, Jerry. So somebody, please, can you help me with your calculator? 10,500 plus this. You can just write it down. All these figures, 10,500 plus 308, this plus this minus 2770, this plus this. Just help me write it in your notes. Help me calculate it. I'm coming for it so that now there is no adjustment to share capital. Just put your share capital 50,000 a year. Put it there. Now, which other adjustment we have? So now we have deducted this. This one is 0. Now, retain earnings. I think we still have some adjustments. Which adjustment do we have again? We are seeing additional information 4, which is we are done with intangible assets, but we are still in provision. How much the provision we are recognizing? Provision. How much is the provision we are recognizing? How much is the provision we are recognizing? Okay. Provision is this plus this. No. Okay, this is provision now. Where's our unwinding cost? Our unwinding cost is this is our provision. 12.87 plus this. This is our provision. This is the provision we will recognize. Please, sorry, apologies again. This is the provision. 13.9. Abi. This provision we will recognize. Now, out of that 13.9, we will now recognize a deferred tax of 2780 deferred tax assets. Let's put it here. Deferred tax assets. How much? 2780. Now, 2780. This place will be 2780. Now, that 13.9, we are now going to deduct this deferred tax from it. So, what is it going to give us? It's going to give us 13,900 minus 2780. Then you get 11,120. 11,120. So any other adjustment? No. Okay, there's one adjustment. Finance cost. So these accounting entries for finance cost. Unwinding interest. Unwinding interest. We debit profit or loss, which is going to retain earnings. So we deduct it. Unwinding cost 1,037. That's all. So what's next? Provision. Provision of provision of 75,000 that was reversed. Remember our provision, the one they did wrong. Provision for replacement cost, which was wrong. This one, additional last sentence, they said provision was incorrect and should be reversed. So we debit our provision, we minus provision, and we credit retained earnings. So that is our last, and we credit retained earnings. Retained earnings. Retained earnings. 75,000. So Who will help me to press calculator? Somebody will help me to press calculator. So this is 4,800. So let me mute everybody's mic. Hello. People are running away, eh? Yeah. People are running away.
Data.
Hey. Okay. All right. Data, Abby. Okay. So there's no adjustment for this again. I said it earlier. So who will help me with the figure, please? Figure. I said somebody should help me with calculator then.
Provisions
Okay,
11,120.
11,120.
Provisions 11,120.
Thank you. Then, okay, loan notes, no adjustment. These are free mark. And that's what I told you in my day one, that anything that you see that there is no adjustment, please put it there. Do you believe that this thing is 1 mark? This 50 is 1 mark. Bonus. So retain earnings, please. Retain earnings.
10,500.
People are going away. I think I can get this one. 62,500. This financial assets.
Retain earnings. 289,060.
It's what?
289.
289.
030.
Are you sure?
Please don't give us. Please. Okay.
So return earnings.
289.
401. 170.
289,030. Okay.
So return earnings. 401 170.
401
170.
401 170, correct.
Thank you.
Oh, sir, sir.
Yes.
That 84,500 is not supposed to be 84,000.
Yes, sir, it's 84,000.
Is 84. We debited.
It's 84, sir. It's 84.
Is it 84? Okay, 84, Abi. Okay.
Yes, sir.
Yeah.
Oh, thank you. So it was reflected in the calculator.
Minus 500. Right?
So it will be 40,0670.
40,0670.
0670, yes.
40.
Yes, sir. 0670.
400,670.
670.
400.
400.
Okay, 400. Okay, thank you. 400. 670. Okay, this is fine. Now,
Intangible assets 52,600.
52.
Intangible asset 52,600.
Okay. This PPE.
318,500.
318,500.
318,500, sir.
I knew it. So now, this is what we are going to do. And everybody, please, let's take notes. Now, when we are translating, we are about to log out now. When we are translating, when we are translating all SOFP, we will translate using closing rates. When you are translating through P or L, you use your average rate. Average rate. And that's what they are trying to test last diet. That's P or L. You are going to translate using average rate. So look at the question. Voila.
Please mute everybody.
Please, we are about to end the class, so that's the reason why I do not want to mute everybody. So let's quickly find the opening rate, the average rate, and the like. So this is it. This is the opening rate. The opening rate is
2.50.
This is it. This is it. This is average rate of, yes. This is the average rate. We don't need this one. This is for P or L. This is what we need. And at the balance sheet date.
That is paying.
Yes, this is what we need. This is what we need actually. So, and the standard also says that this when you are measuring your
is indirect.
When you are measuring your
Subsidiary.
when you are measuring your subsidiary, that you should use closing rates for your all your SOSP.
Assets.
So
And liability.
all the current assets you should use, but this share capital, the standard say we should use the opening rates.
Opening rates. Share
Yes.
capital.
What's our opening rate? 4.what? 4.2, Abi?
4.2.
Yes. So this one will be 4.2. That's what the standard says. So, but all the rest here, there will be
Closing rates.
So there's no need to use calculator. I'll use Excel. I'll use Excel. So that we can end it.
Now to get this in the wala.
So this is what they are asking. They said we should prepare the consolidated something that will be suitable for consolidation. So this is what the examiner is asking. But
how many hours?
And that's why I said at the video, for you to write tight and you need to allocate your time. Just use 15 minutes. So if you use 54 minutes. Yes,
hello, sir.
Yes, ma'am.
I'm sorry. My network went off. To translate statement of financial position, which exchange rate did you say we will use?
Closing rate.
Closing rate.
Yeah, closing rate.
They are here for you.
Closing rate. What of P or L?
Average. Average.
How average rate are we? Is the examiner going to provide it, or we are going to devise something?
The examiner will give you now.
Average rate.
Oh, she likes that.
Average.
Yes. This is the closing rate as a balance sheet.
No?
This is the closing average. This is the opening.
Abubakar, mute yourself, please.
Please, let's mute ourselves.
The question is very, very hard.
Edo.
Even the examiner's report said that the performance was very, very poor. They want to kill us.
This question, it really worth it. This question, if you don't understand standard very well, there will be a big issue.
Last diet and November diet, everything is very.
So that's
just add this last note that you said to the material before you send it.
I will send it. Don't worry.
I mean the last thing you just said about closing rate and thank you.
Yeah. Okay, I should add it to material. Yes, okay.
Yes,
I'll add it. And I will share it. No problem. So please, everybody, 8 o'clock. How many minutes are you going to use to rest now?
Please help us speak with SFM tutor, please, to give us maybe like 10-15 minutes to cool off our brain. My head is bringing out smoke already.
It's bringing out smoke. Like,
Concha with water now.
I can't imagine it.
It's not balanced.
I need water to cool my
Don't worry,
head.
I'll fix it. Don't worry.
It's burning. Fire.
I think we have error here. Do you have error here? Okay, yes. This. At least it should be close. 20. Don't worry. Let's end the class. I'll send the Excel to you. At least we are done with all the adjustments. So that the SFM lecturer can set up the SFM class. I'll message him now. So I'll send you the Excel now. I will look at the error. Even though there is an error, the difference is supposed to be very insignificant. maybe 10 naira or 20 naira. So that's it. We are rushing, so that's
Thank
it.
you, sir.
So thank you, everybody. Thank
Thank
you.
you, sir.
All right. Bye.
Thank you,
Our
sir.
class continues.
Thank you, sir.
You have question, no?
Yes, sir.
Please send it to my DM. At the top, how many questions do you want to ask today?
I think others can go. Okay, I'll call you on WhatsApp then. I don't have
Message me on WhatsApp. Okay. All right. Bye. Bye, everybody.
Thank you, sir.
Thank you.
Bye.
Thank you, sir. Thank you, sir.
Okay. Bye.
This is what we thought, sir.